And they're off. I love Anna, you've got a great lineup today. I know the trader Chick follows me. She's a scalper supremo. She's fabulous. I saw Horwitz at the end. Forgot who was before, but I love this lineup, and I love the 45-minute format because it forces us as presenters to really make it lean and mean. And so I'm rather than speed it in fast forward so that it's harder to understand. I've kind of, as always, cropped my presentation to kind of just show you the highlights and the important stuff of the presentation without any of the fluff. So again, happy to be here. You know, the title of this 4-person presentation talked about trading insiders. I think I'm more of an outsider. I'll tell you why. Because I approach trading from a mental and emotional standpoint. You see, most traders have the talent enough and the smarts enough to be successful, but it is the mental and emotional part that causes 90% of all traders to lose. Actually, the figure is 91% last time I checked with the transactional firms that keep records of these kinds of things. So to be in that 9%, I believe that not only do you have to have a decent trading plan, but you have to have one that fits you mentally and emotionally, one that you feel strong and positive about through all of the losses that the trading plan may take, the losses in a row. Every good trading plan can take 5-6 losses in a row and still be a very good trading plan, but it can start to bang a little bit on your confidence. So there are some rules that I believe that you need to follow in order to help yourself get through a series of losses in a good trading plan, and also to keep a high personal profile when you're trading. I think it's important to have that positive expectancy, and I'm going to go through a little bit of that here. And the way this presentation is going to go, I'm going to present to you my thoughts on how to limit risk first in a trading plan, and then I'm going to go to some live charts, and I'm going to show you how to apply that kind of a notion in a particular trading plan, a simple trading plan that I built about 19 months ago, and have been using it almost exclusively because the more volatile the market gets, the more important it is to put limit risk first in your approach. Okay, so let's just check that you can hear me okay and that you're going to be into this. Give me some action in the chat of some sort. Just say, hi, Norman, you look terrific, even though I know you can't see me. I know you would look terrific if anybody want to just throw a chat in just to let me know that you're here and you're with me, and either that or in the questions area, and I will continue on. Okay, let's take a look at, first of all, if you don't know who I am, I think there are a number of people here. I see that some of the names that are familiar with who I am. I've been in this almost 4 decades. I've written several books mostly on how to design trading plans and so on. There's still, I think, 1 or 2 available on Amazon and so on. But I have a deep background in helping traders and institutional traders even to succeed. I worked for Payne Weber for a while. Only spent a couple of years there. They were more of a sales firm than an investment firm, and I, believe it or not, the way I was asked to have my day go. And so I spent a lot of time, about 8 years, with one of the largest option firms in the country, International Trading Group, where I was responsible for 60 traders under me and also training managers to take over other offices in that particular endeavor. I formed the Hallett Group, where I was managing as a commodity trading advisor, high-moneyed individuals, several million in the futures market, and put most of those trades through my own IB at Hallett Commodities. However, the last almost 20 years has been spent really with my love for the important thing about trading, that most people ignore, and that is the mental and emotional part. This is the part that gets you. When you take that big, deep loss that costs you dearly, all the winning that you did all that last week or last month in one stupid, crazy, out of your mind trade that you know you shouldn't have done, but somehow you could not hold yourself back, or whatever the case is. But I'm going to show you the process to be a little bit more formulaic, so that you have a formula. Okay. First of all, why a limit risk first approach? Large losses, that is the #1 reason for trader failure. Now, we're coaching about 30 traders right now individually, and we just got through with our group coaching, of which, because of that, I've got a little time, and I'm going to give you a bonus at the end because I have a little bit of time that I'd like to spend with those traders who want to improve. But the large losses, that's the reason, the #1 reason for trader failure. It's like a gut punch. It takes the enthusiasm out of your trading and causes the number 2 reason, because fear of large losses is the #2 reason for trader failure. And as you can see, they're related. If you take if you took a large loss and you got that gut punch, you know you shouldn't have done it, and your trading plan somehow allows for it, or your lack of trading discipline allows for it, or you don't have the mental and emotional training in order to stick to your trading plan and avoid the large losses. When you take a large loss, the most detrimental thing that happens is not so much the loss that you take, that's bad, but it's the development of the fear of large losses. Once you take a large loss, then you fear that you're going to take another one, and that becomes a real problem. It becomes a real problem in taking trades. You wind up looking for the perfect trade. You watch trades go by that would have made you money if only you did the right thing in the first place, and that's to follow your trading plan without hesitation and without failure. Now, and when you do that, when you can turn around the mental and emotional construct to follow your trading plan and trust in your trading plan, then these 2 reasons for trader failure, they disappear, and you then are in the group of 9% that actually can win at this, and some win very well. Let's continue. If your trading plan is reasonably good, limiting losses allows you to live another day. Now, a trading, I have an expression at the disciplined trader. We talk about that we always say to ourselves that I'm a wise and disciplined trader, and I do the things that a wise and disciplined trader does. And if you have a trading plan that is reasonably good, it doesn't have to be the best trading plan ever. It's just one that's been back tested, one that you've simmed for a while and can see that will make you money. Then you've tried it with a minimum number of positions so that you can run the trading plan with as little risk as possible, but still you have skin in the game. You've taken those first 3 steps, okay? Back testing, sim trading, minimum allowable to run your the trading plan live trading. And once you've done that and you see that you would have made money over the long term, then you have a trading plan that is likely reasonably good. And it's not because somebody else did a good job with it, because that's another big mistake. That could be reason number 3. Just because somebody else has a trading plan that works for you, it doesn't mean works for them. It doesn't mean it's going to work for you, because a trading plan needs to fit you and the type of and your personal psychological makeup. Okay, it's much easier to follow a trading plan that complements your mental and emotional well-being and your mental and emotional intricacies than it is to have a trading plan that doesn't and try to change yourself to the likes of the trading plan that is not a good fit for you. So the first thing, of course, is to, and this is not this presentation, but I have to say, you need to stop the music and you need to say to yourself, okay, what are my strengths and what are my weaknesses? If I don't have a lot of patience and I'm a person who is a type A, I'm going to need a trading plan that gives me some action. Otherwise, I'm going to yearn for the trade and therefore wind up taking trades that are off the trading plan or just slightly off, just because you need the action and then you're a type A. So you need the kind of trading plan that fits you. Okay. In my book, I talk about. This is a quote by a very famous trader, me, that I thought I would share with you, because really it sums up what we're doing right here. Traders shoot for a high frequency of winning trades with targeted profits. This is what I'm telling you here is the general strategy of being a successful trader. Traders shoot for a high frequency of winning trades with targeted profits. That means putting a limit order in. And when the market hits your limit order, you're out, as opposed to trying to live the dream with every trade. See, that's what happens with a lot of traders. If it comes to their trading target very quickly, they say, boy, this could really go. Let's take out the target and see how long this can run. Big mistake. Okay, so traders shoot for high frequency of winning trades with a targeted profit, usually small ones, and immediately and without hesitation limit losses no matter how they feel about a trade. Okay, so in the case of a winning trade, you may have multiple positions where you take a quick profit from one, and then you put your stop in, lift your stop to break even on your remaining positions. This is a normal process when I build trading plans, and should be for you if you care to build one on your own. Numerous successful successful small trades can add up to impressive annualized gains as long as the losing trades are nipped firmly and quickly in the bud. The bottom line here is you've got to have a trading plan that keeps your losses small. Okay, there's three types of trading plans. There's scalping, there's swing trading, and there is position trading. And we're not going to go through position trading today, because unless you take on contracts and small share sizes that are once you start holding trades overnight, which is what position trading is all about, you have that overnight risk, especially in stock, where you're not trading for several hours and things can happen, like a tweet or a world situation. Something can happen, and that you can't do anything about because there's no trading happening, and you're victim of the next open of that market. So I'm going to talk, when you're limiting risk, it's usually best to get out at the end of a trading day if you want to. This is the best way to limit risk, okay, to the smallest amount. All right, so let's talk about the first two. Here's the advantages and disadvantages of scalping. Scalping, of course, is where you take short profits, where you're not asking. Scalpers are usually in trades somewhere between 1 minute or 30 seconds and 2 or 3 minutes. Usually not within a trade for much longer than that. There are advantages to scalping. Generally, small prescribed losses when you're only in for a few minutes, although crazy things can happen. When you're usually using charts that have small time frames in every bar, and if your stops are placed based on those bars, the previous bar, the previous before that, the two previous bars, you're not going, it's not a lot of distance, so therefore even on a total loss in a scalping trade, it's a small prescribed loss. Also, traders with limited time to trade can complete trades. You know, you can get in there, and we coach a gentleman who's a very successful trader that trades for an hour a day, and he uses tick charts, and he trades and he's in and out of a trade in minutes. Okay, so that's one. Those are a couple of the advantages. There are more, but those are a couple of the advantages. The disadvantages is that also by prescription, you're grabbing small wins, and a chop can result in chewing up account equity without the possibility of large gains to overcome. In other words, scalping usually doesn't let you in there for the large gains. You're usually taking small prescribed gains. So if you're getting chewed up, it's really hard to have that next trade bail you out as it can in some of the other ways of trading, in swing trading, etc. But I think that from a mental and emotional standpoint, the psychological challenge of scalping is that you say to yourself, boy, I could have had a much bigger profit if I had stayed in. In other words, you're in a scalping trade. You only want a couple of points out of it. You put your limit order in to take those couple of points. The points you're taking and the market continues to explode, and you say, boy, I mean, I understand the importance of scalping, and over time it's going to work for me, but you know, gosh, I wish I could have stayed in that trade just a little bit longer. So that's a psychological challenge. Again, I like to expose those because this is the real challenge that's going to happen as a scalper. So the conclusion is, to succeed, you need a plan. To succeed as a scalper, you need a plan with a high percentage of winning trades, okay? Because you're taking small trades, you're taking small wins, and therefore you're going to need a high percentage of winning trades in order to have those wins accumulate to a reasonable amount. Okay, the advantages and disadvantages of swing trading. Okay, the advantages, of course, opportunity for large gains. In a swing trade, you usually have an open-ended trade where you take on some sort of trigger, the crossing of two moving averages, a bar moving over crossing a moving average over or a check of the 200 moving average, whatever it is. You usually have a trigger, and that trigger puts you in the market, and you usually use some sort of trailing stop in swing trading, or some sort of stop that recognizes the current volatility. There are several ways of putting in stops. That's a different discussion, but the opportunity for large gains are there because you're allowing the market to move, and you're protecting that move, if you're smart as a swing trader, by continuing to lift your stop as the market advances or declines, depending if you're long or short. Also, traders with limited time to trade, they also can complete trades, because generally a swing trader is a trade that goes with most of the ones that I've created, most of the ones that I've seen in the past from people that we coach, are swing traders are looking for corrective actions in markets that have already defined a trend, and you're moving with that trend, and you can complete that trade usually during the trading day without holding it overnight. There are some situations where if you get a huge move and it's a Friday and you're ending on the high of the week, to keep a position or two, a percentage of that over to Monday there's certain high percentage situations where maybe you want to keep a swing trade over the day, but very, very rarely. In fact, if your trading plan says don't do it, you're probably being smart about it. Okay, the disadvantages of swing trading is that you can often give back profits before offsetting. The market moves. In fact, if you have a strong move in a 1 bar period, if you're trading from a 5-minute bar or a 10-minute bar, and in that 5 minute you have a huge move in the S&P of 20 points because something came out, your stop is going to likely be below that bar, and many times the market can come back and take back some of the gains that you thought you had, because you're using trailing stops as opposed to a targeted exit that you would have in a scalping trade. So the problem is you can often give back profits before offsetting, and it has a larger potential loss, of course. You have the initial and that give back you kind of mentally describe as a loss, because you're allowing the market to swing back and forth, and it usually means that in your initial stop that's going to be a deeper stop also, because you're likely allowing for volatility or whatever. So these are just some of the advantages and disadvantages. The psychological challenge is when, and it happens often, where you're giving back a lot of what you gained in a power move in your favor, because you're trailing it with a stop that's underneath a previous bar or two. And the psychological challenge, you say, well, man, if I had just taken that profit when I had a chance, instead of so in many cases the swing trader is thinking, maybe I should go back to scalping, because you can take that profit and it's never taken from you. And the scalper is looking towards swing trading because gosh, I wish I had left that in. And so, wouldn't it be nice from a mental and emotional standpoint, and if also from a risk standpoint, you could have both at the same time? And in swing trading, you'd have to conclude that that you can afford to have a lower percentage of winners when you're scalping than when you're scalping, because you, even though you may have 2 or 3 losses in a row in swing trading, the losses are measured losses, okay? And then when you get a winner, that can run enough, that one winner can run enough to overtake all your smaller losses and then some. So there is some forgiveness in swing trading that doesn't exist so much in scalping. However, if you have a good scalping system, it's going to have a high percentage of wins. And so there are benefits and problems with each one. But I think as a trader, you need to discover for yourself which is best for me. Now, we all have both going on in our heads. We all wish we had taken a profit when we saw it come back and take away from us. If the market takes it away from us and we had it, that's wish you could. And we also have some that wish you would have taken it quicker because the market backed off right from the beginning. So there is a way to do that. So what if we were to combine the benefits of both scalping and swing trading? You would have a small prescribed losses, okay? Beautiful. That's really the nature of what we want to do first and foremost, from the previous slides and from all of my experience in trading and all of my experience coaching everybody. If you want to stay in the game and be profitable in the end, be one of those standing in the end with a smile on your face, you got to keep the losses small, okay? And what if you took small gains frequently? That would be nice too, because those are going to add up, and you had a trading plan that allowed for that, and you had the opportunity for large gains at the same time. What if you had a trading plan that took on multiple positions in the beginning, where you took small gains on some, moved your stop to break even on the rest, and allowed for large gains in a swing trading type of fashion? Okay, what if that were the case? And avoid account draining and chopping markets. This is some of the tougher things that you do. When a market starts to chop, you're better off moving to the side. But how do you know it's going to chop? How do you know it's just not 2 movements back and forth? There are ways to tell. We can't go through it here, but in every trading plan, I include nuances that are things that you can learn from, of course, and make the trading plan even more accurate. But also you can fit into your trading style. As I said in the beginning, you need a trading plan that works for you. And so I always include nuances in my trading plans that allow you to take or leave them based on who you are mentally and emotionally, okay? But still run the same trading plan with a little bit of stop. I want to show you this. This is an important, are you with me so far? Can we get a little action in the chat so that I can tell that you're with me? I see we have a lot of people here today. Yes, okay, somebody's with me. Appreciate E.G. Scott. All right, makes sense. Let's get going. Let's get into some live. We're almost about halfway through, and I want to get into some of the live trading so that you can see. I want to show you this first. This is a trigger that I use in a trading plan called Loaded Gun, and I'm going to show you that trading plan right here. It looks like the reason I called it Loaded Gun, and I really shouldn't, because there's a lot of controversy about guns and so on, and I don't want to be a political guy. But this looks like, if you turn the barrel upward, it kind of looked like a handle and a gun. And since it's an explosion on the upside with the large ball, in this particular case, on the upside with a large green candle, then Loaded Gun I thought was a good idea, so I stuck with it. What you see here's what you want to see. This is a trigger, okay? And when this, if I were to draw an 8-bar exponential moving average through this, probably be coming down like this, and then coming across here, and maybe this big bar would turn it up a little bit. What I'm looking for is a hesitation bar, which is here, which is either a spinner, which this would have to be called a spinner because it does have a body. The body, of course, is the distance between the open and the close within the time period that you're dealing with. If this is a 5-minute bar chart, all these trades, this is the price, the Y, this is the Y-axis, the price is the Y-axis, and this, of course, is time down here, this axis. And what you're looking at is from here to here is the prices that the this particular commodity or this particular whatever stock is traded in that 5-minute period. This is the open here, and this is the close. How do I know that? Because the bar is green, and it's the body. The body defines the open and the closing range. Here, I'm looking at the body, and I'm seeing that it opened up right here and closed just a few ticks lower right here. So it's a very small body with most of the trades falling outside of the open and the close during that 5-minute period. This is indecision. See, the Japanese farmers who created this candlestick system believe that the important part of the trade is the open and the close of the time period. Now, they use a lot of the daily charts, of course, but it's true of any time period. When you have an open and a close that are almost equal, if this was a line where the open equaled the close, it would be called a doji. This is a spinner. Okay, if I'm looking for a spinner or a doji, the smaller the body, the better, because the more defined the indecision is, in my perspective, the better it is. If that indecision is followed by a dramatic decision through the 8-bar exponential moving average, and I'm going to show you this on a chart, on several charts, that is my buy signal. I am buying at the bottom or at the close of this bar. I'm buying right here. And I'm looking at my clock as it's ticking. Tick, tick, tick. I'm pushing my finger. It says 59 seconds. I'm pressing the buy at the market button to buy right here. Okay. This is the trigger that, I'm going to show you how often this trigger works, so that you can, those of you who need to trade a lot, you have it. Those who don't need to trade a lot can look for the most refined triggers, the smallest body, so that the greatest indecision followed by a movement higher. Okay, now one thing I will say before we get to the charts is that when you looking at this, your stop, when you buy here, your stop is going to go below the formation. So it would be a tick. Now some people, traders, and they're just as good at traders as I am, they like 3 or 4 ticks below. I always do a tick below the bottom, because the other traders believe that, well, they're going to just get you for the tick below the bottom. Well, they'll get you for 3 or 4 ticks, so you might as well put 10 ticks, and then of course you're increasing your risk. If it's not going to work, it's not going to work as far as I'm concerned. There's too many trades to do. I put a tick at the bottom and I forget about it. Okay. Now, one thing I will mention. Let's get to the. You want to get to the charts? Let's get to the charts. Alrighty. Let's go with. Well, let's go. One last thing I want to, because before I get to the chart, I want to give you this, because I'm not going to get back to this likely. I want you to have this so that when we're done with this, if you want to take advantage of the simple trading plan, which is in its completion only $397, plus you get a coaching session with me on how to work the plan. Okay, you're going to get all that for $397. Simpletradingplans.com. Okay, but you're going to use the code STP100. So just write down simpletradingplans.com, STP, and the coupon code STP100 for your $100 off. Okay, so let's get into some charts here. Okay, here's my this is the chart that I look at, and just to kind of give you a focus, if you see down here it says 130, let's or 10, let's go to here are my 10-minute charts. Okay, and I look at mostly commodities. I do some stocks, and but here's my commodity board where I'm looking at actually I've limited that commodity board right now to the micro S&P, okay, micro E-mini contract, and the micro gold contract, because these are very, very small contracts, and even with $5,000 accounts, you can do some damage if you don't watch it with these contracts, but you can also make some nice money with these contracts. Okay, now here's if I were looking at this, I would be looking right here. Okay, I would expand this chart. This is the 10-minute micro S&P chart. Okay, you see what's happening here? I'm getting a possible short signal. This is a shooting star. Let's blow that up a little bit. This is a shooting star, okay, followed by a movement through the 8-bar exponential moving average, through the, so I would be a short, I would be short here at approximately 34.27, looks like 34.27 and a half, and I would be putting my stop up here at 34.35. So that's a 7-point risk. That's about a $35 per position risk. So if I had 2 positions, if my math is right, I'm going fast, so don't hold me to it. It'd be about a $70 risk if you shorted 2 here. Now, what I would want to do here, okay, is that you have 2 positions on. I always suggest that you take on 2 positions, okay, and you can do it with this micro, with the micro S&P, okay. Where do you take out your first position? Where is the scalping part? So in the first position, I want to be a scalper. In the second position, I want to be a swing trader. So I measure this distance. I measure the body, okay? And without getting too formal, well, let's just take a look. I just don't want to slow down. If I look at the open, it's at 32, 34.32. If I look at the close, it's 34.27. Let's call it 34.20. That's a 5-point. That's a 5 points length in the body. So I'm here, I'm in at 34.27.25, and I would put a 37, so it'd be 34.22.25. I would be looking to buy back. So I'd be buying back somewhere in here, okay, on that first position, okay. If I'm not going to stay here, looks like I would have gotten hit with this, with a nice profit if we come down, but you never know until it's hit. Here's my limit buy is right here. If we do get that, I would be moving my stop from up here on the remaining position to break even. So I'd be locking in this, the profit. I would be locking in the profit I took on the scalp position, and I would have a free trade, so to speak, on the, and with the nuances and the trading plan, I show you how to move that stop. Okay, looks like I'm about to, I would be about to be getting out. Now this is a counter trade, because the trend is up. Now, what's interesting about the S&P is that these counter trades, and there was, you remember on Monday when the market dove, this system caught it not only in it, well, I'd be taking my profit here now, 5 points below, and then I would be moving my stop from here to here. So now I've just demonstrated to you the system in a real trade, okay? And now I would be moving my stop according to a particular plan, but I can't get into that now. But I will say that whether you traded the 5-minute bars, the 10-minute bars, the 30-minute bars, the 60-minute bars, the 240-minute bars, they all caught that movement down in the S&P, okay? And the greatest percentage gain against risk, in this particular case, it was, say, a 70-point risk, $70 risk. Those gains were somewhere, even in this contract, with 1 contract left out of the 2 contracts, was $300 or $400, okay, in that move that happened on Friday. Was more than that on last Monday. So look at this. Can't stick with it, but you can see, if I just get out of the zoom in, you can see the potential here. We break this, whoops, let's see if all right, let's see if there we go. If we, I don't know why I'm still getting, okay. In any event, you can see that in this particular, if we break here, we can have a nice big trade on our hands. So I just demonstrated a trade that would have been a pretty nice trade over the long term, okay? Don't know why this is sticking with the, well, let's keep going. All right, so I've just described to you how to, let's see if I see another one here. See, here's another signal, okay? Here would be a signal, all right? And in that signal, okay, you would be selling here. So let's explode this chart here just to show you. This is a 5-minute chart. Let's get out of the, okay. This is the 5-minute chart, and you can see now this is a big risk, so you would have to, a bigger risk than we looked at before. You would have to, okay, now let's look at this. Here's a losing trade, okay? Now I'm going to show you a losing trade here that you would have had your stop in here, and this would have been a total loss trade from here to here, because you would have been stopped out here. Actually, if you use one of the nuances that we have, and most of you would have been stopped out in here, but I can't get into that except for to say that if this was a total loss, here's the distance of the total loss. Then you're not, you're not hurt by that. You would take this trade, you would be getting your first trade out, your second trade would be in here, you would be out in this bar right here. So here's another similar signal, okay, where you have a doji, a small spinner with a movement higher. This was a nice trade. Here's another signal that's similar, okay, small, a spinner here, followed by the move lower. You would put your trade, your scalping position here to buy one back. You would have bought it back, and on this bar, you would have moved to break even, and you probably would have been break even. Actually, you would have gotten out here, so you would have a tick or two. But I can't give you all the exit strategy here. It's there are 3 or 4 things that you watch for an exit strategy that are very simple. I call these simple trading plans. Okay. So this is kind of what I watch, and I watch a 10-minute bar because that's really where I like to play, in the 10-minute, 5 minutes and 10 minutes, because the risks are very short and I can be in a very long. Now look at this. Here's the development of our last trade. Okay, and you're seeing what you're saying to yourself down here. Well, I wish I would have taken it. And if it does come back up and hit us, okay, we took a nice profit on the first one, but this one looks like it may expand. So but I'm just saying that the psychological damage that happens when you're one kind of trader than another is nearly eliminated with the program that I'm showing you. I want to show you real quickly because we don't have much time left. We only have a few minutes. But I wanted to show you the loaded gun. If you go to simpletradingplans.com, I showed you that link before. You're going to see the explanation. And see this is one page of the simple trading. This is the simple trading plan loaded gun. It's printed out all on one page. Here are the entry rules. Here are the exit rules. Here are some of the things that I showed you. But in the course, there are actually videos on explaining more and more about what I've just done over and over again with stocks and so on and so forth. I'm going to get back to a couple of examples in a second. But here are the nuances. These are 7 nuances we have right now that help to match you with the trading plan and help to limit the risk even further or keep you in a trade and don't bounce you out. So these are nuances that you can apply to the main trading plan, okay, that can help to fit who you are. And you're going to get 60 days of working with this plan on your own. I mean, I can add up the value of all of these techniques and so on, but for $497, you're getting a terrific value. And if you don't like it, you'll get a full refund. I have no questions asked. I mean, if you're going to steal from me, I can't help it. But most people who are attracted to me are people who are honest and really want to help themselves in their trading. I offer 60-day, no questions asked. If you don't think it's 5 times what you paid, I'll refund the purchase, no questions asked, okay? But here's I call it a vanishing bonus. I just put this up yesterday because we just ended our group coaching sessions, and therefore I've got some time to work with you one-on-one. Anybody who takes advantage at a $100 discount even, I'm going to give you a 30-minute, and so it can take longer than that, but a minimum 30 minutes one-on-one onboarding. You and I will get on the pipes here, and we'll go through the simple trading plan, and I'll walk you through it so that I can see where your strengths are, where your weaknesses are, and look to maybe advise you on some of those nuances so that you can zoom on those first, even though I'd like you to watch all of them. As soon as you invest in the Loaded Gun Simple Trading Plan, you'll get an email with a calendar link where you'll be able to schedule the one-on-one walkthrough with me. And it'll be with me. I have here on one of our professionals, and that's what happens when I'm working with the coaching clients and so on, and I do these presentations. But right now, I'll do it with you. Anybody who signs up, I will take you through this one-on-one. Not that my people are not good, because I think one's actually better than I am. If you're seeing this bonus, it just means that there's still room on the calendar. So I want you to take advantage of this. Okay, and then when you go down to the checkout at the bottom of the page, make sure you put 100 STP. And when you do and you apply the coupon, it'll say is successfully applied for $100 off. And instead of $497, this thing down here is going to say $397. So simpletradingplan.com, use that 100 STP, and let's get involved. We've got my complete guarantee, and I wanted to make sure that you saw all of that. Okay. You know, and if you I wanted to give you this, I didn't want to confuse the issue, but if you're having, if you are a victim of making too many darn mistakes and you don't have my book, this has been downloaded. It's, well, it's 308,000 times, but this time it's been up for a couple of months. It's much more than that. But I'm saying to you that this is a 30 some odd page book, 35 pages, that really hits hard on some of the mental and emotional constructs that maybe that are causing you to make mistakes and how to get over them. Make sure you go. This is the disciplinetrader.com. I hate to give you all of these, but the disciplinetrader.com/MF4T. MF, mental fitness for traders. MF, the number 4 and T. If you don't yet have the copy of my book, get it. Okay, it's a freebie. The disciplinetrader.com/MF4T. Okay, so let's get back, since I've got about 4 minutes left, let's get back to some of these, to the charts, so that I can continue to show you how well this has done. I mean, here's the E-mini S&P, okay? And you can see how, although in that last trade we saw, we got stopped out of break. Now I'm looking for another trade. I'm not lamenting over what I didn't get here, because this could have been the big fall. Okay, you never know, because the big fall did happen. Let's take a look at what I'm trying to do this slow so that it's not dizzy. Here's the big fall. Here's a big fall. Okay, now this is not a major indecision. However, it's followed by a tremendous decision. You'd have to measure risk here, but look at this. Look at what it caught here. Okay, even on the 5 minute. If you look at the 5 minute chart, let's turn this to the 5 minute. And I've been trading this a lot on the 5 minute. Here is the spinner, followed by the move down. You would have had all this move right here. Okay, not only that, you had another move here that you would have had. And if you were if you follow one of the nuances, you may have gotten out right in here on some of it. Even on this trade, okay, where it's a small, and then you would have gotten out of your first position, because remember, you're measuring the body and you're taking out your first one here and then dropping to break even. Here's another trade that, look at all of these trades. Here's another one, doji or spinner, followed by a movement higher. Okay, let's look at a stock real quick, just so that you can see it works on stock too. I've got about 2 minutes. Let's go with, here's one that I've been watching. My wife's been trading this. This is called BIONX, BNTX, which is BioNTech, which is, is it Norvell, or this is a drug company that's making one of the vaccines, okay? But look at this, right here. When she saw this, she said, I really think we need to get in. I said, wait, let's wait. Well, we stopped waiting right here. Here we got a signal. Indecision followed by here. And this was around the 65 area, 64, 66. And now we're still in it, okay? Going higher, okay? And took the first half of it right out here, I got $3 or $4, and then moved higher. So stocks, take a quick look at, let's say, Tesla. This is the, this is the daily chart on Tesla. Let's look at the 5 minute. And I'm almost done. Whoops. I guess I've got to spell minute a little bit better. Okay, here's the 5 minute on Tesla. Okay, right here is something that we call in the nuances, may have been here is a signal right here. Spinner followed by the movement down. You would have gotten this was a positive trade right here. Here's another trade right here. Spinner, movement down. Nice trade on that. Okay, another one right here. This is a 10 minute. This is a 5 minute chart on Tesla. So I wanted to make sure that you had the knowledge and the possibility to be a successful trader and use the disciplined trader and the simple trading plans, this loaded gun to make it happen for you, taking some short profit, allowing some profits to run. Thank you so much, Anna, for allowing me to be here, and I appreciate everybody for attending today. I hope you got something out of it. Keep the losses small, please.
Hang on a second here. Let me open up all my tabs. Okay, hi everybody. Thank you so much for being here with me this morning and with everybody. I love listening to Norm. He is probably one of the best for psychology of trading. Definitely one of my favorites to listen to as well. And so today what I want to do is I will be covering quite a lot of fun information with you guys. However, the main objective of me being here today is really for you, right? I don't really need to hear myself talk. I'm here mainly to help you guys out. It's really important that you guys are interactive with me, ask questions so that I could expand on anything that I am talking about so that it makes more sense to you guys and that you could really, really get something out of what I'm offering my presentation today. Okay, so please don't be shy and let's begin. And I would love to hear you guys talk. So there's a question box, so go for it and start typing away during the whole presentation. So Trader Chick, Simplifying Day Trading. Today, what I want to speak to you about is understanding market language and how to spot high probability trades with analysis. And this is me. I'm Marina, the Trader Chick, and that's one of my little humans right next to me. And just a quick intro so that you guys know who I am and where I am coming from. So I'm Marina, the Trader Chick. I am an expat. I live in Antigua, Guatemala. This is my family. I don't know if you guys have ever been to Antigua, Guatemala. It's really, really beautiful down here. I've been living here for quite some time. However, what's interesting, a little interesting fact about me is I am trilingual. So I'm actually a refugee from the Soviet Union. I arrived to the US with my family actually more than 41 years ago at this point. And I was pretty much raised in the US. So I speak Russian. It is literally my mother tongue, but it is not my main tongue because I was raised in the US. So I speak obviously English a lot better than other languages. Um, I do speak Spanish fluently as well because we have now been expats in Central America for almost 20 years, actually. First, we lived in Costa Rica, and then we moved to Guatemala. My husband is Guatemalan, so he's technically not an expat, right? But I am. So I do speak Spanish fluently as well. And the reason why I bring this up is because it's really being trilingual, especially learning a third language in my late 20s it teaches your brain to recognize certain things about languages and things. And I recognize that the market is its actual language of its own, which I will get into during this whole presentation. But I wanted to give you a little bit of uh, background. So we are travelers, obvious at the moment. We have been completely homebound. I'm sure as the most of you have. It's been very, every time any plans we make, we're constantly changing. But but normally I have done pretty much everything around our travels. We usually travel 2-3 months out of the year. Before I became a day trader, I was a fitness instructor and actually a travel writer. So the reason why I bring this up is because so many people have this misconception that you have to have financial background or a math background, economics. You don't. I was a fitness instructor, and this is what I mean by being a travel writer. I have a travel site that you could actually go to today. It's still super active. It was my first online baby. And this is what my background is. So if I could do, you guys definitely, definitely can. So before I jump in to the actual presentation, I created a free worksheet for you that you could follow along with this presentation. Just go right here, right now, makingofadaytrader.com, and you can get it downloaded immediately. Okay, so makingofadaytrader.com. Go and get the worksheet, and then you can follow along with me. And remember, please send me your questions. This is all about you guys, okay? And let's begin. What are the basics of day trading? Hang on a second. Let me just make sure that I have my questions. Yeah. All right, let's begin. What are the basics of day trading? So basically, a easy way to explain the basics of day trading is, and something that I am actually in a really great position right now to really see it. My son, who's 16 years old, is learning how to drive a car. So at this point, I've been driving, for way too long, probably over 30 years. So for me, getting into a car, it's just so automatic. I don't even think about any of it, right? It feels like I was just born knowing that information. But the reality is, we weren't. And my son is constantly asking about where's the accelerator, where's the clutch, where's the, where are the gear shifts, the windshield, all of that. Those are like the basic language of the car, right? When we jump in, we know this, but we learned it. And whenever he brings it up, I'm like, oh, of course, you don't actually know this because you're not born with this information. It's the same thing with trading. There are certain things with trading that if you don't learn them, you can never fully drive that car, right? Like if you don't know how to go into reverse, you are going to be missing out a huge part of driving, right? So the same thing with basics of the market language and understanding how the market moves. And once you learn these four basics and make them as automatic for you as what we get in car, it's amazing how it was going to up level your entire trading game. Everything you do, I can guarantee you will have a complete new level of trading. So before we jump in, I personally trade the ES Mini. This here is literally, I work off of one chart. That's all it is. I call the chart as a canvas, like an artist has their canvas. For us traders, our charts are our canvas. I use two indicators, only two. And I use EMA lines, which is the exponential moving averages. I use them right here. I will go into it a little bit more how I use them. And I use the MACDs. I absolutely love the MACDs. Without them, I cannot do a single thing. So basically the MACDs, why I love them the most is because there's so many indicators and the majority of them are lagging. And we know that, right? They always lag a little bit. What I like about the MACDs is that they're probably the least lagging indicator. And when the goal is never to be on the side of the market when it's starting to become weak, right? We always want to be where is the most amount of strength so that we get the most out of our trades, right? And the MACDs start to show weakness really what good on in the trend. So you know that there is a high chance of you being stopped out. Okay, so basically these are the MACDs. Again, I created this worksheet for you guys for this presentation. So please get it right now, makingofadaytrader.com, so that you can follow along with me and have it for you. It's literally what I use when I sit down and trade. So it's a really cool, I call it my cheat sheet. All right, let's begin with market movement and the breakdown of a trend. Look, we all understand and logistically know that there are three trends, right? We know that. We know that there's an uptrend, we know that there's a downward trend, and we know that there's a sideways trend. However, the thing about sideways trends, and I'm really going to hone in on this today, is I call it the trader's worst enemy. Why? And I can guarantee you almost everybody here today could say the same, is that we lose the majority of our wins during the sideways trend, right? Why? Because it is an indecision area. It is a really gray area. It's an exhaustion pattern, indecision. I mean, you name it, it is all of that, right? So we have to be able to identify it and really understand what it is. And that's what I really want to talk to you about today, right? So just a quick breakdown so that we really understand trending markets, right? We have a downward trend, sideways, indecision, upwards, right? What is an upward trend? Pretty basic. Each pivot goes higher than the next, right? It's really simple to understand. This is an upward trend. We could call it a bull market, trending market, going up, whatever. When we have a trending market, we're going long, we are buying. So we're entering at a at a position that is a lower price, entering at a higher price, right? It's pretty basic. Going long, right? Entering here. Downward trend, the exact opposite. Each pivot is a lower than the next. And it's very important for you guys to understand this. Day traders, we do not discriminate. We make as much money on the down as we do on the up. A lot of people are like, oh, well, some people are losing money. Who cares? We're not about those people. It's us. It's us and us only. do not miss out on downtrends, on shorting markets, because it will be a gold mine. All right, so you have to understand what it looks like, right? What is selling? What is going short? It's when you're entering the market at a higher price and saying that the market is going to go lower, and and the profit you're making is that in between. Okay, so short that market, people. Do not start feeling compassion. That is not about it. That's why algorithms and high frequency trading work so well. There is no emotion behind it. I know trading is a very mental thing, and I will talk a little bit more about that, but you've got to become logical. You've got to just focus on the right decisions and making those decisions, not about what others are doing and what are people thinking. You'll never know, and you'll never know what others are doing. Trust me on that. You could stop that right now because it's a waste of energy. Okay, so what is it called? The bear market, shorting the market, whatever you want to call it. I want to talk a teensy bit about overall momentum and immediate momentum. I personally am a scalper. So scalping is going for small, quick profits, right? So even though we could have an overall trending up, we also do not want to miss out on the short mini trends, which I call immediate momentums. Okay, now consolidation areas and transitional areas, right? Like what I've called them before. I'm telling you, this is the trader's worst enemy. And I have talked to thousands of traders, and I have also been trading for over almost 9 years. Trust me on this, they never work. You can never make money in these areas. I know people are like, well, I could go up the resistance area, support area. Not if you don't have a clue where the resistance area or support area really is, because some people don't even put those in. Okay, so consolidation market. This is when the market bounces back and forth. It's literally a channel, a sideways market, whatever you want to call it. This is it. Okay, now I want to talk a teensy bit about emotion and the mental issues that we traders go through, because it is mental, right? It's almost like a 90% mental thing. It's one thing I always say, I could teach anyone to trade, but your mental strength is really what's going to get, push you to that next level or keep you sabotaging yourself. So this right here, consolidation areas, indecision areas, whatever you want to call this area, the chop, exhaustion, I don't care. It's all the same thing. I get people getting so caught up on the words. They mean nothing. The bottom line is it's this flat zero momentum area. This is where the mind tricks play the worst on you. So here are the two scenarios that happen when we see this kind of a market. Okay, this is when stories totally sabotage us. There are two types of traders. The one is the trend is your friend kind of a trader, and the other one is a contrarian trader. I personally am still, but at this point consider myself a contrarian trader. So what is a trend is your friend type of a trader when it comes to consolidation areas? They see the market going up and they're like, that's it, the market's going up, and all of a sudden the market is in a decision area. Their mind starts to play tricks on them. You know what? The market's been going up all day. I'm going along. Now, the contrarian trader is the opposite. The market has been going up really strong, and their mind, they're like, you know what? The market's been going up too long. It's got to correct. I'm going short. So here's the deal, guys. The market doesn't have to do anything. The market is going to do what the market is going to do. So all your stories, they're bullshit. They do not work. So you got to stop with the stories right now. Okay? And this is crucial. And once you get out of your story, then you could actually start looking at the market logically. Okay, so let's talk logically about the market. Here we are going down, consolidation area. Now, if you do not have your resistance and support areas built in, they are literally the seat belts of your trading. They are like when you get in a car, would you ever go without a seatbelt? Maybe some people will. I mean, I live in Guatemala, pretty much, it's whatever you want to do. However, if you think of yourself as a NASCAR driver or a Formula One driver, because let me tell you, the adrenaline you feel when you're in the live market is probably similar. Do you think they would ever get in their car without a seatbelt on? Absolutely not. They're not stupid, right? They know that they have to put on safety measures. This is your safety measures right here, okay? And this is how you could recognize when it is a strong area as well. Now, you could have mini consolidations But if you're scalping, this would totally stop you out, right? This is what they look like. I'm going to go in a little bit more explaining exactly how to start to spot these before they get into all of this, right? So this is what they look like. Now, areas. I've said this once before about the support and resistance areas. I'm going to say it again and again and again. The market respects areas. It respects areas. And we as individual retail traders have to respect the market with them. Okay? We have to respect it. Otherwise, guess what? You're going to crash. Okay? Support resistance areas. These areas are so important. They're so important, guys. I get so many people saying, "Oh, I know, and I know what they look like." No, you don't. You need to draw it in. That's why it's a canvas for us to draw, to write, because when you're in the live market, everything to the left is what's going to make sense. And if you don't have anything down on the left, and you're entering a trade, guess what? You're going to be freaking out, wondering, why did I enter it? Because your mind is going to start to play tricks on you and doubt. But if you have everything set up to the left of you and you know that you just made the right decision, it doesn't matter what the market is going to do. You are prepared, right? What is that book called? The War of Art or something like that. The warrior dies before the battlefield. Our battlefield is when we go live. We have to be ready before that. Okay, so let's talk about support and resistance areas. If you guys get anything out of my presentation today, learn the support and resistance areas. What's a resistance? It's a ceiling. It's the ceiling of a trend. It's where the market hits an area 3 or more times. If it hits it 2 times, I will get into it a little bit more. That's reversal patterns. They are not areas. Okay, you need to know the area. Resistance area is the ceiling. This is the ceiling, and the market revisits those areas. It respects those areas, right? It hits it over and over and over again. If you're like me, if you scalpers can only be in the market for about an hour, hour and a half. This is about an hour and a half session. Look at that. It revisited that area. Even though it gave me mini trends, it revisited it. I have to be prepared and know. And when it hit that area, I'd be like, and goes off of it, I'm like, of course it's a resistance area. Okay, resistance area, it's the ceiling. What's a support area? It's the floor. Again, an area is only formed 3 or 4 hits, and I mean like actual hits, not bars. We cannot get that micro. You will kill yourself if you go that micro with analysis paralysis. No, it's hitting with retracements and pivots. Support area, it's the floor of a trend. Sometimes it could just transition the trend, or it could break through. We cannot decide what it's going to do, but we have to be ready for what it's going to do. All right, this is what a resistance support area channel looks like. If you don't have these drawn in, you might be looking at a chop and not realizing that when it finally breaks out, you're missing out on an insanely great opportunity. Okay, these are those channels, resistance support areas. You have to know these areas. This is a large channel, but is it a pretty one? No, it's really ugly. It's really choppy. Okay, so you have to understand that just as well. Okay, is the link not working? Oh, thanks, Anna, for putting it in. It was working this morning, makingofadaytrader.com. I don't know, it was working for me perfectly. Hopefully it's working for you guys. Please let me know. If not, I will check afterwards. All right, so continuing on, you guys have to understand this, okay? Resistance and support areas, they also can move, and it's totally normal if they do, okay? So, but you have to be prepared. You have to recognize it. You cannot be stuck on, oh, it was here and why isn't it not here anymore? Who cares why? Now it's smooth. So you got to go with the flow. All right, now it's about recognizing them before recognizing consolidation transition areas before you are in too deep. You will probably, and I would say the majority of people, they do end up losing the first trade when it becomes a consolidation area. It's pretty common, but if you continue going in, then, you know, what did Einstein say? You know, if you can repeat the same thing over and over again, you're insane. And that happens so often because our emotions take over, right? It's such a mental game. All right, so how do we recognize and how can we read the beginning of a consolidation area. And like I mentioned earlier before, the goal of traders is to know when the trend is strong and when there is a possibility for shifting. Do you really want to be in a maybe situation where the trend can shift? Why would you? Why would you give your money for that? Why? Save it for when there's actual strength. How do we recognize when that begins? Reversal patterns. I live for reversal patterns. This is the language that I live by. They are my telltale signs. What are reversal patterns? Double tops, triple tops, head and shoulders. This is what a triple top looks like. Now, coupled with divergence, and this is where the MACDs play an integral part of the trading, because here you have price action going up, yet on your MACDs, it's starting to diverge and head down. What is that telling me? In the live market, it's telling me there's a slowdown. And this, you see this retracement can happen anywhere when the divergence begins, right? So basically, what I want to do is I want to be fully ready and not be anywhere near the market. I'm conservative, okay? Super conservative. So let's take a look a little bit more into recognizing reversal patterns, because reversal patterns are also the beginning usually of a resistance or a support area. Look at that, double bottom, divergence, divergence. Look at that. When I see reversal pattern and it has divergence, I am nowhere near the market, because you're going to learn one important thing. And if you guys are not doing that right now, is to back test. Do you guys even know what back testing is? Because back testing, if you don't do back testing, you can stop right now and just stop trading right now, because you're literally just giving your money to the market. Back testing is making sure the trade setups and the patterns you are thinking are working in your favor, or they're patterns that you're saying, you know, every time I see this pattern, the market usually shifts direction. You have back tested at least 45 market days in simulation. Not, you know what, this looks like a good pattern, and go and try it in the live market and you're going to lose. You know what happens then? Two things. One, you obviously just lost, but two, you start to doubt yourself. You start to be like, I'm such a bad trader, but you're not. What happened is that you did not back test properly. I have back tested divergence without reversal patterns and with reversal patterns. First of all, when it's reversal patterns, I don't want to say it's definitely 100, like 95% that it's going to reverse, but the chance of it reversing with divergence is literally in the 90 percentile, right? So would I enter a market anywhere if I see that immediately? Absolutely not. When I'm seeing divergence start to happen without reversal patterns, there is at least an 80% chance of it to reverse. Now, do I want to be in that? Absolutely not. I never want to be on the smaller end of the market, right? I don't want to be in a market where it's only 20% chance of me actually winning. Okay, we traders, we do not go in 100 times in like that is another misconception. Trigger happiness is a real thing. It is a syndrome of day traders, especially beginners and ones that are not seasoned, right? I actually consider day trading. I like to do a comparison of day trading to hunters, even though I'm totally against hunting, but it's a very good analogy. A big game hunter does not go out and shoots every little, you know, prairie dog or mouse, you know, field mouse. No, they wait for the big game, right? Snipers, they can sit and wait for the long time. Traders, we have to be like that. It's about being conservative and being smart and understanding what the market is doing. Triple top, look at that massive divergence. Okay, I'm going to be putting this all together so you guys kind of see how it's all put together, right? Because those are the automatic. Again, you have to get the makingofadaytrader.com. Go here right now, because everything I just went over is in this cheat sheet. It's literally what I use when I sit down in front of my charts. So get it. It is going to help you guys so much. Okay. Honestly, just those little things alone will truly revolutionize your trading. And it doesn't matter which market you're in. You can be in any market. Okay. But day trading mainly, swing trading as well. You just have to look at a bigger time frame. All right. So I want to talk about a really, really big, excuse me, a really big trade setup that is probably one of the most easiest to spot. But if you don't have your seatbelts on, if you don't have your resistance and support areas on, you're going to miss it, right? So to do this in layman's terms, what is a breakout? Usually a breakout is when we're headed in one direction, we have a consolidation area, and then we break out in that same direction. But let me break it down to you in total layman's terms. So when you're sitting in front of your computer next time and you're having everything set up and understand it, you really get it. Now, this is, imagine you are getting into your car, okay? And you live right here. This is you in the south part of wherever. And and your friend calls you up and they're like, hey, come over, let's hang out. And your friend lives north of you. Okay, now you've driven this road 1,000 times, so you know it, you're super confident. So if I was to bet on you or like take a trade on you, I would usually be in the very beginning part because we pretty much know getting out of your house, getting onto the main road, you're really confident with that drive, right? All right, cool. Now you're getting on, you're headed out, you're going north, get on the highway that you've taken 1,000 times to your friend's house. However, all of a sudden there's a big sign and it says construction at work. Construction, road closed. What happens to you? I don't know about you guys, but I'll tell you what happens to me. My mind goes into total doubt. I start to really get stressed. Why? One is, okay, what if the detour, excuse me, what if it's not a well-defined detour and they stop putting up signs? I don't know this area. What if I get lost? What if it's a bad neighborhood? Oh my gosh, so now I'm in total freak out mode. All right. Other thing is, all right, well, what if they take the detour, but they never fix the road and I have to be on this detour the whole time? Oh my God. What if I accidentally get lost? I don't know where I'm going and it's gonna take me hours to get to my friend's house. Or the other thing is, you know what? They're gonna say, you know what? The road is so messed up, you can't go, turn back around and head home. And the detour going home is, I can't figure out. What is going on in your head, guys, during that time? Stress. You are uncertain. You do not understand what's going on. This is a consolidation area. That is how you should understand consolidation areas. You do not know what is going on in those moments. Do you really want to be entering trades when you're in that kind of a state of mind? Absolutely not. Why would you do that to your hard-earned money? So now all of a sudden the detour ends, the construction guy opens the road and he's like, all right, you're back on that highway. Guess what? You guys are feeling so pumped. You're finally back to certainty and you're driving. Would you take a trade right there? Absolutely. Because you know this road. This is where you know that there is the most amount of almost like 100% confidence that you are going to go continue on. And that's where you want to be. And that's the breakout. It's literally continuing on. Okay, so hopefully I broke this down for you guys really well for you to understand what is a breakout trade so you understand. Now, consolidation area. But again, if you don't know when you're in that zone of uncertainty, you're going to just keep on losing the money, right? So the breakout trade. I'm going to go into it a little bit more here. Let me just see if there's any questions. Okay, I will talk about my platforms and everything once I am done with showing you guys, and you could ask me all those questions for sure. Okay, so breakout trade. Here is a super strong resistance area. Boom, you broke out. This is where my MACDs come into massive play. I have massive strength. I use my EMA lines as a place to take the trades. This is where I enter the trades. I never just go in on a large bar. Just because there's a breakout, I also need to have a place to stand like an archer shooting an arrow. Okay, another trade that I absolutely love is that instant reaction trade. It's like when you literally just leave the house to get in the car and you know exactly where you're going. That is where you want to enter right away. And again, it's all about the strength. It's also seeing that transition. It's also seeing when that shift happens, right? It's when it's shifted, when the MACDs are super strong. This is my zero line. This is that massive spacing between. I have that mini retracement here, but it retraces back to my area. This is where you want to be, right? Remember, making up a daytrader.com. I have all this information there for you. Plus, you could email me, you can send me your charts. I love to chat with you guys, okay? This, you can get your free cheat sheet. And now I want to go into, the live market with you guys. Let me know if you are able to see my charts. Just say, hey, yes, I can see your chart really quickly. Let me know, guys. Okay, first, okay, cool. All right, now I will go over everything now on my chart. So I use NinjaTrader. I am not affiliated with NinjaTrader, so you guys could choose any platform that really works well for you. I know Thinkorswim is a good one. I know Sierra Charts, MetaTrader. There's quite a few that you are able to utilize the universal indicators for free that are part of the software, right? You do not want to be paying extra for indicators. If anybody's offering you that, that's a scam. You do not need that. You could get by with just regular ones, okay? So I use NinjaTrader. I personally am an E-mini trader. E-minis is the futures market, right? It's literally following the S&P 500 index. So this is what I use. I use 3 EMA, exponential moving averages. They're very different than the moving averages. Moving averages is usually, you know, during the year. Exponential is before, like if I use 20, 52, 135 exponential moving averages, okay? So this is what it is right here. So let me know if you guys have any questions about my charts or anything like that. So just to go over really quickly here, as you can see, the market has been pretty ugly today, right? I mean, we're not gonna say it any other way. It is just choppy, ugly. It's also a little bit erratic. It's hitting these areas. Right now, we are in a very uncertain time period in the world, I think, other than the fact that it's also election. We do have a pandemic on our hands, right? And a lot of people, the market just doesn't really make sense. And lately, especially coming closer to the elections, you're going to see this a lot more often. Nothing to do with politics. It's just more uncertainty. Okay, they are not moving averages, Khurshid. They are exponential moving averages. It's a very big difference. EMA. Okay, and that's 20, 52, 135. Okay, so, but for me to not know this, like for me to not have my safety belts on, my security belt, I'm not going to be able to understand that, right? And also, do you really want to be in a market that is this choppy and grindy and uncertain? Definitely not. You want to be prepared. And let me tell you another thing, guys. It's okay if you do not take a trade. There are 3 really important positions in trading. One is knowing when to get into a trade, knowing when to get out of a trade. And I say the most important and underused is knowing when to stay out of a trade. Do you just want to be giving your money to the market? Because I see that so often that it really just is breaking my heart. Okay, sometimes you don't need to give your money. Sometimes it's absolutely okay to be like, you know what, this market is crap. I'm not touching it. It's okay. And that's really important for you to understand, because when I began, I was trigger happy. I was going in 30, 40 times within an hour and a half. First of all, the commissions alone killed me. Secondly, to this day, I would like anybody to prove me wrong on this, but meet any seasoned trader and they will tell you trigger happiness does not count. So what I've actually been doing a lot with my with my students is doing a 1 trade per day challenge. It's amazing how you start to filter out all the crappy things that you thought were good trades to find that one beautiful trade, because that's the only one you are able to take during the day. And that could also, just a little side hack, could truly, truly revolutionize you. My email is thetraderchick@gmail.com, or you could go to thetraderchick.com as well, and you are able to write me there from there as well. Oops, hang on a second, guys. Okay, so as we can see right now, the market is pretty crappy. Again, I also use tick charts. I don't know if any of you guys have ever used a tick chart. I really highly recommend it. I started with 3 monitors, 10 indicators, and I've learned to really simplify it and go down to almost no indicators. I'm down to 2 indicators. And what I use instead of a volume, because volume is important, we need to know if there's volatility, I use tick charts, right? So I use a 610 tick chart, which for every single bar, this is the coolest thing of all, is there are 610 transactions happening in real time. If you use a volume indicator, it is a lagging indicator. We don't know what's happening in that exact same second. But here we do. We know if it's a lot of volatility or if it's crazy slow, it's right here telling us right in the bar, right as we go. So this is what I use, okay? At the moment, to be honest with you guys, I wouldn't be anywhere near this market. I am saving my cash. really, saving it. It's not worth it, okay? And when the market opened last night around 5 p.m., it was okay, but now it's just crap. It's totally indecision time. You know, there's elections coming up. The stimulus package didn't go through. COVID, it's all these things. You do have to take those into account. And when you're seeing this, be like, you know what? I'm calling it a day. It's not worth it. Okay. So let me know if you guys have any questions with the chart. Hang on a second here. Just want to close a couple. Okay. All right. So again, this is what I would look at in the live market. I find my support areas. I find my resistance areas. I look at exactly what's happening, the MACDs, divergences. I need to know all this because if I don't know this, I will crash and lose my money, right? Is not giving the option. Absolutely, Curtis. It gives you the option of 610. What I use, guys, it is not uncommon. It is an incredibly common time slot. Trust me, it's there. My favorite MACD settings, super easy, Bruce. So when you open up MACDs, they usually have 3 different things. They have the difference, the average, and the actual MACDs. I only use the MACDs, and I use 12, 26, 9. Super easy. Okay, and what is the 3 values of the MACDs? Right, so it's the 12. Here, I'll open it up for you guys so you get to see. Oh, there we go. What just happened there? Can you guys see the MACDs right here? 12, 26, 9, universal. And what I do is the average and the difference, I just make them transparent. Okay, so super basic. None of the indicators I just showed you guys are paid. They are everywhere, and the tick chart is a very common chart. All right, guys. Oops. Back to the presentation. I only have a few minutes left with you guys, and here's the cool thing. Wasn't that interesting, like to watch the charts with me live? Now, imagine if we could do this every single week together. And I'm truly excited about this part of the presentation because right here is what most traders can do to unlock what is holding them back. And let me ask you this, do you know if you are doing it right? Literally, do you guys know if you're doing it right? Let me break this down for you. Okay, let me break this down for you. When you get the cheat sheet that I've been really telling you that I literally use, you immediately get put on an exclusive VIP list. So remember, makingofadaytrader.com. Okay, and this way you get put on a VIP list as well, and you get a special invite. You get a special invite coming into your inbox. And I've made something very special for you. Simplifying day trading. Simplifying day trading. This is my signature course right here. Okay, this is where I give you everything you need for this. However, the one thing that is really important is, and this is only for participants only. For participants only. If you sign up right now for the Making of a Day Trader cheat sheet, you get also a special invite for 6 months one-on-one mentorship program with me. One-on-one, we get to do this together. And on top of that, if you sign up for this, you get an extra bonus of 6 months free membership into my live trade chat room. So it's literally live, and I'm not talking about like working with moderators or anything like that. I am literally talking about me implementing everything that I have just gone over with you live. And on top of that, 6 months of working one-on-one with me. But it only happens if you sign up right now. Hi, Thomas. One-on-one right now, okay? And because the program is so robust and there are so many things that I talk about, the mentorship, the live chat room, and also you get lifetime curriculum access. But you can only get this invite if you sign up. It is only for live presentation only, okay? And I don't want to give away the price of the course because that's not really what it's about. The thing is, one thing I will share with you right now is that I want to surprise and delight you because of the value driven of what it is. And it is literally going to be less than the price of one average trade. One of your average trades, that's what this, okay, it's going to be. But again, you have to find out to get notified by going to makingofadaytrader.com. But here's the thing. As with everything, there is a catch, okay? Here's the thing. I can only take 25 people. I am only able to take 25 people because due to my one-on-one mentorship, I am only able to take on 25 students at a time so that you get my full attention and commitment to you. And this is only going to be available for the people live in the presentation. No one else is going to find out about this particular offer. Okay, so you have to go to makingofadaytrader.com and get your cheat sheet, get on that special list. Remember, when you get the free cheat sheet, you get put on that VIP list and you are eligible for the 6 months one-on-one mentorship. 6-month live trade chat room where it's me. It is not some moderators. I don't hire anybody. It's only me. And that's why I'm only able to take on 25 people because it's just me. And it's that one-on-one helping you, okay? And you'll also have lifetime curriculum access for Simplifying Day Trading Futures course. Now, if you have not gotten the cheat sheet right now, go and get it. makingofadaytrader.com. All right, now, if you guys have any other questions, please let me know. And again, here is what we will be looking at. This is the market. Again, right now, I would not come near this market at all. It is just absolutely crappy. Yesterday was pretty good. We did have massive choppiness and sideways market, and then it finally broke through, right? Yesterday was pretty awesome, and it was until market closed, but it did give us another choppiness. And then when it closed, the market just reopened, and this is what it pretty much started to give us. Okay, this is the ES Mini. Again, let me know, guys, if you have any questions, and you can sign up makingofadaytrader.com. And I'm here for any questions. And thank you so much, Anna, for having me. And thanks to everybody for joining and being here. I really appreciate your time. Thanks so much, everybody. Have a really great afternoon.
Well, welcome everybody to Investors Expo. I'm David Morgan of www.themorganreport.com. I'm a big picture analyst. I look at the macroeconomic picture, specialized in the resource sector, and right now the market's telling us we should be focusing primarily on the precious metals, gold, silver, palladium. Today I'm going to take a look at money, past, present, and future, kind of an overall. I'll get specific into the cryptocurrencies, and then I'm going to have to switch screens, Anna. I probably won't fumble the football. It might take me a minute or two. I want to go through the Morgan report of a month ago and point out some very interesting things for everyone. So let's get started here. Let's see if I can get this. So this is a very brief history of money. Everybody's probably familiar with this, but as a review, basically it was a barter system. And then about 700 BC, the Lydian coins were made. I won't say minted. And that was trying to get a uniform unit of account, a uniform measure. And then it went through the cycle you see where basically we're all familiar with the Roman Empire that started with the denarius. And the denarius was the unit of account and was basically almost a pure silver coin. It was republic, there was real freedom. The Senate really represented the people, and things were good. And as the Roman Empire deteriorated over a number of years, and they couldn't really get the amount of money required to run such a huge empire, they started to do what all empires do, and that's debase the currency. In those days, there wasn't a printing press, there were coins, and that coins were the only money available. So what they did was they demanded everyone to turn all their coins in to the government, They would take those coins and they would smelt them down, add other metals, copper, usually, and they would debase it, making the silver content less than it was previously, but at the same time demanding that it had the same value as the previous coin, which of course everyone knew it didn't. And that was debasing the currency or debasing the coinage and causes inflation. So things cost more and more as time went on. From going from the beginning of the denarius to the end, the first one was almost pure silver, as I said. At the end, it was a copper coin that was basically plated with silver, but the plating in those days wasn't very good. So it was, I'll say, washed with silver, and it basically wore off the coin pretty easily with, you know, some transactions. And of course, my thesis, along with Robert Prechter and some others, is that there's a direct correlation between the debasement of a currency and the debasement of society at large. And this can be proven over and over again, not just with the Roman Empire, but Byzantines, several. So as the lie about money starts and continues until the currency is basically utterly destroyed, you have more and more moral and societal problems. People start to question the authority. They see that the rich are getting richer and that the poor are getting poorer, and that there's a problem with what they're saying versus what they're doing. And the trust in the system breaks down. And it's, from my perspective and studied view, it has a lot to do with the trust of the monetary system. So let's move on. From 700 BC to the 1960s, silver actually has been the most used monetary unit. And really, if you think about it, I know Anna and everyone else on this presentation are not as old as I am. I'm probably the oldest in the group. But the point is that in my lifetime, we were still on more or less a quasi-silver standard. It ended in 1965. And after that, things started to deteriorate fairly easily, I'd say, until August 15th, 1971, when Nixon took the United States off the gold standard, which was basically taking the world off the gold standard. And from that time till now, the inflation has accelerated substantially. There was some measurable inflation before that, but nothing like it's been since then. And now we're in a situation that's almost unbelievable. We've added 30% to the money supply just in the last few months. We've added more money in the last few months than it's taken like 200 years to accumulate. So it's very trying times ahead. And that's why I've been such a silver advocate for so long. As the slide says, silver has been utilized to protect wealth, purchasing power, and establish commerce for hundreds of years. Silver to gold ratio has been somewhere between around 15 ounces of silver for an ounce of gold, and Latin America is the primary producer. Paper money was invented quite some time ago, and it was by the Chinese. And what's interesting about this is the Marco Polo expeditions, which are pretty well known for my age group, taught in elementary, or in 7th, 8th grade maybe. The point is that, you know, it was this adventurer, but the one thing that they don't really tell you, you have to do study outside of the government-run schools, was he was absolutely impressed beyond belief that people would accept a piece of paper as final payment. And coming from Europe, you had to have, you know, a silver or a gold coin as final payment, something that had intrinsic value. But the Chinese were passing these pieces of paper around and considering it to be final payment. And that is what he brought back. It was the biggest thing that he brought back from his adventures, silk and spices and all the stuff you read about in the history books. But the main thing actually was paper money. Now you can see that we degraded from what was a gold-backed system for a long period of time in the US dollar history until, as I said, recently, really within my lifetime. And you can see up in the upper left, excuse me, let me get a drink of water here. Sorry about that. So the left-hand corner is a $20 note. And you can see it says $20, and I highlight in red, in gold coin payable to the bearer on demand. So that's actually a receipt for money. It's not money as in and of itself. It was traded as money because it's a receipt or a claim on money. So that is a claim receipt that at that time, you could take that in and get a $20 gold piece. They were equal. And of course, that was a standard banknote, as it says here, between 1882 to 1933. And then in 1933, as you know, it's often said that the U.S. confiscated gold. They really didn't confiscate it, just for those with a historical bent and a penchant for the absolute truth. It was nationalized. So everyone that had one of those gold coins instead of a $20 note was told to turn the gold in and get that warehouse receipt instead. And then what they did after they collected as much as they possibly could under the penalty of jail time or a fine or both, they revalued gold by 75% or 70, I forget the exact number, and put it at $35 an ounce. So the further history, brief, obviously, it was Bretton Woods Agreement, where every currency in the world will be backed by the US dollar, and the US dollar is backed by gold at $35 an ounce. And then, as I said earlier, that was suspended in 1971. So you can see in the sheet over here on the right that we have a situation where we had the deterioration of the, whoops, sorry about that. Trying to get fancy here. So you can see here that in 1913, a dollar equals a dollar. Right now, it's really about 2 or 3 cents. So they've lost about 98% in just over 100 years. And you can also see that a dollar was worth about 30 cents back around 1971 or so. And this fall off has been pretty rapid. And it obviously fell off during this monetary inflation as well, but not quite the steepest slope. So the effect on the populace, you know, not investors, it affects everyone. I was going to say not investors. It does affect investors, of course. Investors have the ability to protect themselves, and in some cases actually come out with a windfall, as long as they understand what's going on. But you can see here from this chart that I did last year that in 1970, when I was in high school, bread was $21. Excuse me, been a long night. 21 cents a loaf, and now it's about 10 times. It's about $2.50. Look at a movie ticket, and those are cheap movie tickets. My local place, I think, are around 13. House, 24,290. That's over a tenfold increase. What was the Canadian stamp worth back then and now? Bleach. So you get the whole idea of what has happened with like the minimum wage at $1.60. I remember those wages back in 1970. And now, of course, it says $7.25. Depends where you are in the country. Really, here in the state I'm in, it's about double that. It's $15 in many places as the minimum wage. So it picks the pockets of the people. There's a fine line. Technically, there's no absolute definition of what is a hyperinflation. It's sort of one of those things, you know it when you see it. I'm not trying to be cute. Inflation is subtle enough where most people can live with it, accept it. They may not like it. Some will understand it, some won't. Some will blame it on the wrong cause. but it's something you basically can live with. It's like, oh man, my cost more to send my kids to school, or my health insurance payment went up, or my house insurance payment went up, or blah, blah, blah. But they're usually going to raise on their wages or whatever. So it's tolerable. It's stealing from them, but it's stealing from a little at a time. When you hit hyperinflation, it's apparently obvious to the most undereducated person that they're being robbed, that the money, quote unquote money, the fiat is deteriorating to a level that is unsustainable and cannot continue. And that's the point of inflection, where people will seek anything and everything they can to protect themselves. We all know, or most of us at least, accept that there's such a thing as self-preservation, an instinct to protect ourselves against harm. Survival instinct, it's often called. And I think there's also a financial survival instinct. It's part of the instinctual process that when you realize that you are going to lose everything you have because the money doesn't work anymore, people will seek out what they can. And that, of course, primarily means the precious metals. But that isn't all it means. It could mean lumber. It could mean like plywood, for example. It could mean foodstuffs. It could mean tires. It could mean jars of peanut butter or a case of tuna fish or whatever. And that's what will happen, in my view. And I've been looking at this my whole life. I've studied monetary history for a long time. And unfortunately, it doesn't give me a great deal of pleasure to tell you this, but that's where I think we're going. So we see this in this chart, financial cycles and major world crises, which is pretty interesting on this chart, where you see what happens with the Great Depression, which I think we're entering another one, World War II, the Cuban Missile Crisis, the oil shock of the 70s, the 87 crash. And this is with the red line showing where we got a correction, I'll call it, of at least 30%. And then the black line is where you get at least 50%. And what we name that Armageddon. This is from Julius Baer and Bloomberg. And unfortunately, but I'll tell you, because I tell it like it is and I don't sugarcoat it, I think that this time we're back to the Great Depression levels. I think we're going to be back into the Armageddon nomenclature. That's just a word, but as far as the repercussions, unfortunately, I think we are on our way to some really tough times. Doesn't mean the end of the world, doesn't mean you can't survive, doesn't mean you can't make money, doesn't mean you really, I'll just digress slightly here to make the point that there were a fair amount of millionaires made in the Great Depression. And the people that made a lot of money in the Depression were people that found a need and filled it. So when people needed entertainment, that was something to kind of forget about their worries, go to the theater, or, you know, sin stuff does really well in depressions, you know, booze and cigarettes. So now there's, you know, there's marijuana and all kinds of things, but I'm not advocating one way or the other. I'm pretty neutral. I'm pretty agnostic on that stuff. I'm pretty liberal in that sense. I'm fiscally very conservative, but on a social scale, I'm pretty liberal. It's your business what you do. So back to the slides. This is The Economist from 1988. The bankers knew what they were going to do. So what's interesting, it shows all the currencies at the base of the Phoenix burning, and then it shows a gold colored coin around its neck with the symbol 10 and the null symbol. It says 2018. It says 10 Phoenix. And it says get ready for a world currency. So I think we're looking at this now. It's obviously past 2018. We're in 2020. These things don't take place overnight, but we're being prepped for a cashless society with a digital blockchain run by the bankers, and everybody will be tracked, traced, and taxed based on their transactions. There won't be any anonymous transactions anymore. That is their goal. This is a slide I was asked for and given permission to use. This comes from the movie Thrive. And as an aside, Thrive 2 is out now. I just purchased the ability to watch it. I watched it one time. I plan on watching it again probably this weekend. But I think this is the most visually correct and important pyramid structure designation that anybody that really wants to know the big picture should look at and understand. I think everybody on this presentation has a pretty good concept, even if they've never seen the slide before. But where we are at the base of the pyramid, really under the base, we see it's us, the people. Whoops, sorry, I've done that again. I'm trying to get the pointer here. So you've got the people, you know, it's all down at the base. Without a strong foundation, you have nothing. So it's people, it's Earth itself, and all the animals, insects, and all that. So that's what makes up reality, really. But then you go up and you have government. Now, this is what the point I really want to stress. And you don't have to agree with me, but as I said, I can build a strong case, as this film did. That government is the lowest thing here on the pyramid. And there's so much argument about political stripes. I'm left, I'm right, I'm in between, I'm neutral, I'm, you know, the best government is communist or Marxist or fascist or voluntarist or democracy or partial democracy or socialism or combination thereof. And all of that stuff is really, in my opinion, designed to keep people divided and fighting amongst each other and distracted from what really is going on in the world financial system, which is the next level up, which is corporatocracy. And this is where the corporations, and they show Bechtel and Exxon and GE and Pfizer and Monsanto, which has now been acquired by Bayer, as you probably all know. And they are in bed with the banks and government. So if you ever watch the movie Network, and I'm old enough to watch it, and many of you probably aren't, but you might this weekend, just get to a search engine and type in movie Network and see if you can find it and watch it. In that movie, the actor, the main actor, who's a news anchor man, basically loses it and tells the truth in front of the camera for the American public. It's a movie. And he says there is no USSR, there's no United States, there's no South America. There's Exxon, there's Bechtel, there's General Electric and Pfizer. All we have is a world conglomeration of these massive corporate structures that are globally based. And that's true. Now, some of these, like GE, really, you know, in a true free market capitalist system, where those that survive are based on the survival of producing products that the market wants and making a profit, wouldn't exist. Exxon's in big trouble. Most of these companies are. The drug companies are still doing great. But they are supplied by these big banks that will feed them money no matter how bad they're doing. Doesn't matter because they play favorites. It's called crony capitalism, which is probably a good enough name. And so you see some of these banks named. They're not all U.S. banks. HSBC, well known for money laundering. Goldman Sachs, everybody probably knows. And then above those are your big banks, the national central banks, which of course you have the European Central Bank, you got the Federal Reserve, and others. And then what banks control them are the international central banks, which is the International Monetary Fund, known as the IMF, and the World Bank. Both basically are creations out of the District of Criminals, Washington, D.C. And then above that, you have the Central Bank of Central Banks, known as the Bank of International Settlements. Now that's out of Switzerland, and that is above the U.S. So you could say that, and I would say it's the Anglo-American empire. It's really primarily New York and London. Now, China was let into the IMF years ago. I forget what year it was, even though I wrote the report in the Morgan report. It's been a few years. But their currency power within the IMF's SDR, special drawing rights, is pretty minimum. If I remember correctly, it's about 8%. And so above that, you have the financial elite that we talk about. You can call them whatever you want. And then, of course, the all-seeing eye that looks over the whole system. So the next time you want to get in an argument with somebody about how important government is, you might just flash back in your mind to this slide and think about all living things, the planet itself, people, crops, all that stuff. Government's just above that. And they're really controlled by a lot of banks. All right, the emerging economies, the BRICS present a potential risk to the U.S. hegemony. And I do believe this is true. If you don't know, the BRICS are comprised of Brazil, Russia, India, China, and South Africa. They've circumvented to some extent the petrodollar system and have moved away from it again somewhat. They also have a settlement system outside the SWIFT system, which is the electronic payment system when you wire money. But I still think strongly that as the US dollar goes, so goes the world. So if the dollar were to fail, or trust in it failed, then I don't think the BRICS would be that protected. They might be a little bit. What's interesting is kind of inflations that we can see, and we show that Latin America again and again has these huge inflations, primarily Argentina and Venezuela, as you can see in this chart. And this is where having precious metals physically in your hand was paramount if you really wanted to survive well, I'll call it. You had a lot more purchasing power if you were able to have looked ahead and able to save in real money. You can see on the right-hand chart how you get this exponential curve on inflations. And I do believe we're heading that direction for the US dollar. So the future of money, I believe, is going to be based on the blockchain. And the blockchain is something that is fair. It's a peer-to-peer system that everything can be looked at and it can't be erased, so there's really no cheating. Now there is some, it's not, in man's world, there's nothing perfect. So one thing I don't like about the blockchain is you can't crawl back a transaction. So for example, if I buy a book on my PayPal account and the book never comes, I could go to PayPal and say, look, I never got what I paid for. And I can crawl back the transaction, and most of the time, especially with the credit card company, get my money back. The blockchain, you can't do that, at least not now. So once you made a transaction, if someone's a scammer, there's really no way to go back on the transaction and say, wait a minute, I was frauded by this. I gave the guy, 20,000 in Bitcoin and I never got the car or whatever. So a little bit leery about that. This is the Load project. I am associated with it. I did invest in it. There are others out there, but everyone's looking for a stable coin. There are some stable coins out there that are backed and one-to-one to the US dollar, which is, I believe, is really unstable. Whereas gold and silver really never vary. Yes, they vary in price, but they don't vary in unit. In other words, an ounce of gold is an ounce of gold forever. An ounce of silver is an ounce of silver forever. There's two sides of this equation. I don't have time to go into it. This tries to explain it, and it isn't an easy system to understand. There's some videos on the website, and again, there's a side, this Load, the blue one. This is where you actually contribute to the monetary mass. This system was started with zero fiat, none, zero. You could not start as a participant in this project with any kind of currency or any kind of digital coin. It had to be funded with silver, which obviously is a pretty small group. But many people that understood where we're going with the monetary system were willing to buy from a dealer and ship the silver to this load project. Now, let me just be absolutely crystal clear here. This is an adjunct to having silver or gold in your hand. It's electronically based. You can take your AGX, not the load we're looking at, the gold one or orange one, and convert it into physical metal. That's part of the deal. But it's primarily best, I think, to leave it in digital form electronically and be able to spend it. But this is an adjunct, I say the word again, to your holdings. So what I have invested in this program is rather modest relative to what I have in the mining shares, resource stocks, and physical gold and silver. But I wanted to get involved because, again, this could be, and I think is, a competing currency to the direction that the powers that be, the financial elite, are pushing us. This is the token or the coin. It's the future of money. Each AGX coin is 1 gram of silver. So a pretty small unit. You can do that in an electronic world very easily. And to get to it, the best place to go is this URL. And I don't think I have it. Yes, I do. There it is. So that's the URL. So it's AG, which is the symbol for silver, .load.1. So if you type in ag.load.1, you will get there. And so I can either take questions or I can bring up the next report and show it to everyone. Anna, what would be your pleasure?
I can't see questions yet. If there is some, wait a second. Next report attendees asking for.
Okay, so it'll just take me a moment to log into my account and bring in the report, which is what I will do. So I'm logging in right now. And of course, I didn't type in my own password correctly. That's because I'm not nervous. I'm just trying to do it fast. Okay, there we are. And now I have to scroll down and go to the archives because we're in October and I want the September issue. And there it is. So Anna, you seeing the September issue now?
Yes, I can see the web page.
Okay, good. So I've got, what, 15 minutes left? Is that right?
Correct.
Okay, good. All right, so I'm not going to read this whole thing to you, but I want to point out some interesting parts about this. So let's see, let me start here. Let's see if I can get this. Oh, I can't do it. So as we have stressed at this point, it's too early to determine if a truly decentralized public distributed ledger system will be available in the long run. Our analysis at this point favors many will be available, but we are concerned that in the future they'll come under more regulation that could be shut down. So I go on to say the most likely scenario would be for competing cryptocurrencies to be available, but to make certain purchases, it would be required to use a government or bank-owned digital currency for essential items such as your utility bill, grocery shopping, your home purchase, your gasoline or housing or rental situation. So let's examine that paragraph for just a moment. What I am asserting here, not provable, and think about it, I don't know, I'm not saying I know. What I think will happen is that the governments, the banks will allow Bitcoin and Ethereum and, you know, all these coins out there to go ahead and be themselves, but they are going to insert their own bank-controlled digital currency. And when that happens, you'll have to like switch, you'll be more or less forced to take on their system from your bank account. So your brokerage account will probably be in the new digital government currency, and so will your bank account, and that's where you'll be starting over. So it'll go, and I'm just basically embellishing this paragraph a little bit. So you'll have your Bitcoin, you'll have your Ethereum, you'll have your load, but the government will say, if you want to buy a house, you've got to purchase it with government coin, with the Fed. I'll call it Fed coin just for simplicity's sake. In the next paragraph, I say, therefore, one can only be on a truly non-distributed ledger and need to convert to the Fed coin. I call it the Fed con, for example, to make it through life, since almost all crypto purchases start with a KYC, know your customer. To think you have some anonymity may prove invalid. You can have anonymity in Bitcoin if you pay cash for it. There's lots of places that you can find to buy it for cash and be totally anonymous and use it. But again, my theory, my hypothesis is that it'll be there. Bitcoin's not going away. But if you want to buy a house, you probably won't be able to do it with Bitcoin. Now, will there be exceptions? Yeah, probably. Somebody that's a multimillionaire or billionaire or whatever and has a house for sale might just go direct to you, and you've got Bitcoin and they accept that and you're done. That'd be like making a cash purchase for a house today. It's pretty anonymous, actually, but in almost all cases. So that's the one that concerns me the most. Again, I'm not saying I know the future. I'm asking the question, but I think it's important that you see that. I did a lot of work on this. This is what you get in the Morgan Report, and they're not all this good. I'll say it. This is, I think, one of the better ones I've written, but regardless, I do look at these big picture items. So this means that the masses of unbanked humans are actually unknown to the banking system as it currently exists. These are people that are cash only, and some are phone only. If they have peer-to-peer, you know, units of account, and they swap them phone to phone. But they have no basic, they're not tied to any bank. So what this means is that there'll be some type of identification. I call it DNA sampling. It could be that depth because I've read it over and over again. Doesn't mean it's going to happen, but there'll be some identification, your retina, your fingerprint, whatever, to determine that you are you, and then you're going to be in part of this blockchain. So it'll be able to track everyone. In other words, many people on the planet, especially young, who never actually have a bank account as we know it, they will never actually have a bank account as we know it. Now, they'll simply comply with the new way of doing business, probably not giving it a second thought, because they grew up on the internet, these 20-year-olds and younger, and many of them will never be without their smartphones, so they take it everywhere, and that's what they'll use to transact. So let me digress there for a minute, and if anyone has a question, just go ahead and interrupt me. I know I've only got like 8 minutes left or something.
Sure.
So right now in China, there was a special documentary done by Stansberry Group, and I will tip my hat to them. It was an excellent documentary. And what they showed in that is that of the 1.4 billion people in China, 0.4 billion, which is 400 million, which is about 80 million more than the population of the United States, never touches cash at all. Every transaction they make is basically off their phone. Also, you can go into a convenience store. I know I've got a worldwide population here, but I know this, obviously, I've got an audience that's mostly US based, some maybe not, but we have 7-Eleven stores, these convenience stores. I think most people that I'm that are listening to this know what that is. It's just a small convenience store. It's got junk food and magazines and cigarettes and booze and beer, and it's a convenience store. So this documentary shows that in China, there's the convenience stores, and as you walk up to the store, there's a facial recognition system. And if it recognizes your face, which in China is like all the population, I mean, there might be 3 people that aren't, I'm joking, but it knows everybody. So you walk up and the facial recognition system knows who you are and unlocks the door. You walk in, you pick out your can of Coke and your bag of chips and your magazine. You walk around to a payment area and it is looked at by a camera and gives you the amount, and you hold up your phone and it debits your account and you walk out. You never see another human being. It's just you in the convenience store by yourself, and it's all done through basically technology. That's the direction that everyone's going. Now, the part about China that's so interesting to me is that it's based on knowing who they are, which is facial recognition, and their social credit score, which has nothing to do with money. Their social credit score has everything to do with how compliant they are to the powers that be. So anyone that resists the authority of the CCP, the Chinese Communist Party, will have a low credit score, or a low credit score, but it's social credit, not credit. But they're exactly the same thing. You could be a billionaire in China, and if you have a low social credit score, the system will not allow you to buy a first-class hotel, even though you got more than enough money to do it. It says you are not obedient enough to be able to stay in this hotel. So if you want to rent a luxury car, it would say you're not obedient enough. Not only can you not rent a luxury car, you can't rent a car. I don't care if you've got $1 billion equivalent yuan or 8 billion or whatever. It doesn't matter. What matters is how compliant you are to the Communist Party. These are scary times, folks. So now, of course, I'll get into the vaccine. I'll just brush over that. See, there's another couple things I wanted to go through. Let's see. This is one I think is very important for people to be aware of. And it goes right alongside with this report on, this is last month's report. This is the September issue, by the way. So we know banks are changing and the moves taking place from our eyes. One of our members brought to our attention a bank called Zenith Bank. This bank is virtual. So this is a bank that's run off a computer. There is no building, there's no tellers, there's no bank president. Well, maybe the bank president, but there's no building. Everything, like I just was talking about in China, is done electronically with no cash. They claim to be solving a key financial inclusion challenge by removing geopolitical barriers. Remember the Phoenix? And what is the Phoenix doing? It was a world currency, remember? To help people get ahead. It's always about us and helping us, right? It's nothing about them having control over us. It's all about helping the people, help the children. All right, so let's examine this. What sets Zeus apart is its international banking license, which allows it to accept and service customers from any non-sanctioned country around the world. Let that sink in for a minute. Does that resonate with that 1988 economics cover? I think so. What Zeus is proposing is for people to consider using a U.S. bank as a complement to what is available to them in their own country. Money held with a Zenith Bank will be governed by the rules and regulations that apply to U.S. institutions. So basically, the Federal Reserve is the biggest quasi-government bank. You know from the pyramid that there's banks above it, the International Monetary Fund, the World Bank, and the Bank for International Settlements. However, for let's say practical purposes, the Fed's pretty much in charge. So they're going to just use those rules that most us people at the bottom of the pyramid adhere to, understand, and have complied with. So that will be their standard. In other words, we'll just say this rule book applies, but it doesn't apply to the US, applies worldwide. So most clients will be able to start the bank account application, receive a digital debit card within 15 minutes. Now, digital debit card is interesting. This is just a series of 16 numbers, expiration date, and a security number. You never get the physical card. Think about it. If you've used Amazon or eBay or any platform on the web, all you do is type in the number. You don't have to have the card. The card's there to look at and type the number in. So this is the way we're going. We're going to not only a cashless system, but probably a cardless system as well. Everything will be either in your head or on your phone. Very interesting. So I think I've got 2 minutes. I don't want to run into anybody else's time. Can you give me a heads up where I'm at?
Sure, let me see. Thanks for the sharing information, David. Trader been asking what film was the pyramid from?
Oh, okay, it's called Thrive, Thrive, and it's let me see if I can get a browser up here real quick. Oh, let me see. So it's a Thrive movie, and I'm pretty sure that you can watch it for free on the net now. And then Thrive 2, as I said, just came out, and I just watched it a couple weekends ago. But this is the official movie, Thrive. What on earth will it take? And I think there's the cover for the DVD right here. Documentary film from 2011. I actually met Foster Gamble. He and his wife were the producers of this. And obviously they're the producers of Thrive 2. And quite an interesting gentleman. I spent an hour with him one-on-one in Anarchapulco a few years ago. And I do keep in touch. In fact, I complimented him on this movie, and the second one is even better in my view. And the second one shows a lot of solutions. There's a lot of, people wanting to remain free, and let's do it ourselves, and let's work together, and let's get out from under this system that we're currently in. Let's make a better one. So is there anything else?
The last question before you go, even two. Thank you. And is silver around a good hedge?
Yes, silver in an inflationary environment is probably the best. And that's not me saying it. Obviously, I just spoke those words. But I based that on Professor Roy S. Jastrom, and he wrote a book called Silver, the Restless Metal. And in that book, Roy Jastrom looked at the history of silver and determined that in an inflationary environment, the best thing to protect yourself and come out really well is silver, not gold. In a deflationary environment, the best thing to have is gold. So I would say you need them both. And most economists will tell you you can't have both at the same time, but you really can. You can have a lot of inflation in the food. Food costs more and more and more at restaurants, at the grocery store, at the fast food place, wherever it is, it costs more and more and more. Most people call it inflation. It's really a supply disruption, but we're printing money. And then you can have deflation in housing prices in the inner city where people are trying to get out into the country. So they're selling their houses at a lower price. So you really can have what people perceive to be an inflationary environment and a deflationary environment at the same time. But silver does protect you. Now, I want to caution everybody, you don't need to put everything you have in silver. Nothing's more volatile than silver. It moves up and down quite rapidly at times, and also with a lot of momentum. And there's other times it just flatlines and does nothing. The point is that you should have some. I really believe that.
And one more question, super quick. Do you recommend miners too, or just the physical metal and gold?
Both. The Morgan report is for people that have bought physical metal and want to go to the next step. You make more money in paper silver and paper gold. I'm sorry, that's just the way it is. So for example, when silver in 2016 went up like 30%, we were in First Majestic, symbol is AG on the New York Stock Exchange. That stock went from $250 to $18. So we made like 6 times on our money, or 600%, while silver itself only went up like 1/10 as much. So definitely pays attention to get into the miners at the right time.
Thank you so much for your answers. And thank you for your great presentation. It's always cool to have you back on our show.
Thank you, Anna.
All right, let's rock and roll. And thanks so much. It's always great to come back with you guys because it's always a lot of fun and a lot of great members and usually a lot of great questions as well. In the meantime, we're going to talk today about our micro mini futures, and we always call it the next big thing because just a quick point in fact, the micro futures that were introduced by the CME about 16 months ago was their #1 product launch of all time. Think about that. They've been in business over 100 years. And they just launched their biggest product ever. So in the meantime, before I can do anything, I got to give you the disclaimer. Okay, and we have, of course, there's always risk, and I'm not going to tell you what you can make. I'm going to show you our real actual results, and you can base your judgment from there. Obviously, future performance is never guaranteed. My name is Todd Horwitz, and I've been doing this for 41 years. Actually, I was a trader that on the floor, and I have been a member of all the exchanges, but when the floor ended, I mean, it's still open, but when you could no longer make the living on the floor, it was time to become a retail trader like everybody else and trade off the screen, which is what I do now. And then I started teaching because I can, and because I know quite a bit about all markets and have traded them all myself in the pits. So I wanted to share information with others. I regularly contribute to the major networks, but the key that I always care about is the bottom one. Every recommendation that leaves this office, I'm in it with you, okay? And I'm not racing you to get in them because every trade we give is released before the market opens, okay? I mean, I send them out at 3 a.m. in the morning, so you never have to worry about me jumping in front of you. Everything is at the same time, and depending on what time you get up, that's what time you'll enter or execute your trade. In the meantime, today we're going to talk about what are our objectives about managed futures. It's the math. That's what we always want to talk about. Everything we do is based on math. The portfolios, I will show you all of them as they stand and how you can take advantage. In the meantime, before we go anywhere, obviously, I always like to talk about the drawdown, okay? Because, of course, in trading, if you don't understand drawdowns, if you don't understand that they're going to happen, then you're just really kidding yourself, okay? Drawdowns are part of trading. There is no way to get around it. There's going to be losing periods. There's going to be losing periods, and that's what you have. We use them actually as a benefit because when we get a good drawdown after we've had a nice run up, we get an opportunity to add to our portfolios and make them even bigger and compound a little bit. But all the results I will show you will not be compounded, but I will show you my actual portfolio, or one of them, because I've got 7. but that it has been compounded. And I'll explain to you the difference. But in the meantime, you got to understand that there are losses, and it's always, I always prefer, I don't present this product often because I have to manage the membership. I want to make sure that everybody's doing it right and be able to train properly. So, but the one thing I always like to do is I love to present it when we're in a drawdown, which we are right now. And because the probabilities are on your favor to start making it right from the beginning. I hate when I have to present it when we're near highs, because I know the drawdown is coming, whether it's a week or a month, whenever it's coming, I know it's coming. So I just want you to always be prepared that that is part of trading, that is part of the industry. In 41 years, I've always had drawdowns. And after that, I'd always gone on to make new equity highs. So that's, again, but you're going to have drawdowns, and it'll come down to how you can handle sometimes you go through losses. We have a proprietary algorithm, okay, that has been built, and we've been running it. And basically what it does is it takes all the information that we have compiled. There's about 120 years of total experience involved here. And this is all using the same stuff I actually teach to people who want to day trade, but it's done automatically because why? It takes out any thought or emotion. Even if you say you can look at a chart naked and not have some emotion or some feeling at a time, all of us have something deep in our psyche somewhere that will force us to make a bad decision. So we use 100% the algorithm. That is all I trade off of when I'm using my longer term trading, which is what I'm showing you today. And I never have an opinion, even if I do. Now, when we talk about mechanical trading, okay, the major reason traders lose money in the long run is because they miss trades, they let losses run. Now, how many of you ever done that? You know, you had a trade, you had something you wanted to trade, and you got in, and you decide, you know, it started to be a loser. You said, I'm going to cancel my stop, and I'm going to let it go and turn it into an investment. And you had a trade that made money right away that you wanted to invest in, but because it made money so fast, you sold it. And that is the most common flaw in most traders is they hold on to their losses and they don't let their profits run. We do the exact opposite, okay? We get out of our bad trades based on the algorithm. Again, that's not a decision made by me, it's made by math, okay? And we are always in the market for the big runs, which is why this model is designed to hit home runs. We have never, ever missed a major move, okay? But we've always had, listen, we'll have losses, don't get me wrong. I'm going to tell you we'll have losses, but we've never missed a major profitable move in either direction because we're not afraid to take the losses when they come. Now, why mini micros? Well, A, they give you a chance to get into the futures industry, okay, because we have bigger portfolios as well, but it gives you a chance to experience trading in futures, because many people are afraid from years back when, you know, when there was a little bit more of the slick salesman, you know, churning your accounts, and some of you might have some major margin calls. There's a lot of reasons, but so they allow you to use your capital properly, also letting you to diversify your assets, fees and commissions, even with the free that you so-called see in some of the brokerage houses, okay, are better. And of course, the biggest key is there's no FINRA day trading restrictions if you're a day trader. Now, we're not day trading. We don't want to make any trades. We want to have our trades on, let them run. So we're not interested in being active. We want to let the trades run as long as they can. Now, the reason we call it next best thing is also you have I don't know if you know, but the difference between options or equities and futures are the tax structure. You pay less taxes on gains in futures than you do in equities. So I believe it's the 1256 income statement, but it's a much better tax rate as well, which is another reason I prefer trading futures, although I do trade both. Now, we've all heard about secret indicators. There ain't no such thing, okay? All you have to do in this business is follow the rules. There's no secret systems out there. Nobody knows what's going to happen tomorrow. We can all make an educated guess, but many have been calling for the top of this market since 2010. Okay, and that was only 17,000 points. So remember, you cannot predict what's going to happen. That's why you want to put yourself in the position that the market is going, and that is what you want to be with the trend. Because all we're trading and using is the logic of probability. Okay. Now, if any of you out there play poker, bridge, backgammon, or gin rummy, okay, guess what? You're going to be able to see, okay, that these are the same as trading because they are math models. Okay, they're nothing more than a math model. Okay, because the better player will always win, the better trader will always win, as long as they use the proper rules in a system of math and logic. And again, it's very simple. You know, you're grinding it out and grinding it out, and you're using the proper skills to make the wins even bigger. Now, this is just, you know, what others have to say, and I always share some of the things that people say. Very impressive. Your market price analysis, yours is the best in the world, most consistent in methodology, most rigorous. Drop the emotions. Don't listen to pundits who comment on casualty and based on reading the news. This is from a professor at Cornell. Okay. Again, it's the point is that we do not let emotions come into play. We know exactly what can happen, and that's it. But here, why professional traders use rule-based trading systems? Because professional traders want to make money. And if you establish an exact set of rules, it needs nothing left to chance. Okay. There are other things that combine in with that. But again, many or most cannot follow the rules of trading and profitable trading. Okay. We all fall into this problem that we believe that we are smarter or better than the market. And at the end of the day, remember, the market is never wrong. Opinions almost always are. Novice traders trade 5 to 10 times too big. They're taking 5 to 10% risk on a trade. They should be taking 1 to 2% risk. And this is another common theme, you know, especially when you get into the world of leverage. Okay, in leverage, you've got, you know, either in options, you over lever yourself, you go broke. In futures, you over leverage yourself, you go broke. And that is something that's very important to understand. And that's our portfolios are structured based on these very facts, okay? So that we don't get into that point. And in fact, in the portfolio models, we have never had to come up with more money to cover a drawdown. We have never had to add money to the original size of the portfolio, which is something that I'm very proud of because obviously it shows that the system works and that we make sure that everybody has the proper balance in their account so they won't have any issues. Now, the basics are what, okay? If you're doing what I want you to do, you're gonna have no opinion. You're not gonna try to time the trades, okay? You're gonna trade just on the facts of the algorithm, on the trades that you're giving, and you make every trade no matter what. This is obviously another common problem. Many people decide that they know better, okay? Now, I do a daily video every day at midday. I send a daily update to all my members, and of course, I always tell them, I hate this position, but I'm in it because I'm supposed to be in it. That's the rules. And it's just interesting because, again, I will always say what I think, but at the end of the day, I'm going to trade exactly to the rules. Subjective or gambling, you've got an opinion. You're trying to guess the market. You're way too emotional, okay? You got no facts, and you're hand picking, which is the same thing as timing. Again, if you're going to do that, you don't belong here, and you really don't belong in markets because you will never, over the long haul, survive the markets if you're trying to time them. Now, the rules are simple. To win at algorithmic mechanical trading, you must have no opinions. Zero, zip, none, nada. Okay? If you violate rule number 1, you're most likely going to lose money. Okay? A trend is the basis of all profit. If you don't understand this, you should not be trading. If you pay attention to the news, you will lose money trading, guaranteed. Because when you get the news, you're about the 1 million person who's got that news already. If for 1 minute you think you know more than the market, price is too high or too low, the market will take your money. It will always punish traders with such hubris. We never sell the top, nor do we ever buy the bottoms. That's for fools who insist on being right, as opposed to making money. If the market is going higher and you are short, the market is right and you are wrong. If you are long and the market is going down, you're wrong. It's that, again, it's that simple. This is not complicated. We're not looking for complicated. We want to make money. The objective in mechanical trading is to mirror what the market is doing. You want to always be doing what it's doing. And if you do, you put the probabilities back. We're back to probabilities. Okay. Trend mechanical trading gives you a statistical edge you cannot obtain elsewhere. Profitable traders understand that edges are essential to long-term profitability. Now, I'm sure many of you heard the name Richard Dennis. Well, Richard Dennis is a friend of mine. Him and I traded together on this and on the CBOE, Chicago Options Exchange, in the 80s. Okay, as he was starting the turtles. Okay, and he proved what I'm telling you now, that you can take people that can control themselves and they can make money by just learning to follow the rules. I've been following Bubba for approximately a year and a half. Since I began following him, my account has steadily gone up greater than 100% profit in the first year. This isn't to say there won't be periods of pullbacks, drawdowns. There will be, and there will be the inevitable any successful trading in any successful trading system. It will be stressful when they occur. Hold your positions, follow new trades when provided, and don't overthink the process or overvalue what you are hearing or think you see in the charts. If you follow the rules and stay the course, a rising account and net liquidity will be your reward. The few times I did stray the program rules, I cost myself money, but reinforced the need to follow the program without question. The biggest temptation will be to book profits on a position going your way into support or resistance. I urge you to look at long positions in NASDAQ in 2019 or gold in June of 2019. There are many more. Both approached resistance, and temptation would be to take off the position, book profits. Both blew through resistance and went to book on bigger, huge profits. Now, what are our objectives? Make money. Okay. We try to keep the variance small, but we don't have any control of that. But that, again, that's the way. That's why portfolios are set up a certain way. We want to be balanced, and we try to keep the drawdown small. But again, a plan in place does not always come exactly to play. But again, we've accounted for anything that would be out of the ordinary as well. And there's my good friend Richard Dennis. Okay, mathematic with algorithmic trend trading, a good trend following system will help you the market until there's evidence that the trend has changed. Again, we're going to be in until a trend changes. Now, this is me. Okay, I got a lot of makeup on there, so I look better. In the meantime, if you've ever heard of a family office, family offices are for where the rich people go. Okay, that's where they get special deals on investments. All kinds of good things go to family offices because those guys get the money. But what I always wanted to do is create a simulation of a family office, and we kind of consider this like a family office environment. And we have, in my opinion, okay, the best product in the world. Okay, as long as you can follow the rules, because at the end of the day, it works. And we've got a chat room for guys that they share information, they talk to each other, and and sometimes you have to help somebody talk them off the ledge. Listen, I've seen it all. In 41 years, I've made everyone mistake myself, and I've also seen it from others, and fortunately been able to correct them. But that's our environment we try to create because we want everybody to succeed. Okay, and all my members that are in the chat room all the time, even on a bad day, they're not whining and saying, woe is me. They are cheering on, knowing that they're going to get a chance to press their positions, which is obviously a great feeling, especially for me. Now, you got to be emotion free. Okay. If you're not emotion free, you have to be you will not be able to succeed. Okay, because again, if you have an emotion, okay, you're going to put yourself in a position to make a bad decision. Okay, because the key to trading success is emotional discipline. If you're intelligent with the key, there'd be a lot more people making money trading. And again, think about it this way, right? If you allow your emotions to get in the way, the highs will be too high and the lows will be too low, number one. And number two, you're not making good, healthy decisions when you're emotional. And I just use this as a reference regularly, okay? If you have ever said something to somebody, the minute those words came out of your mouth, you wish you could have jammed them back in like the cartoon characters. That's what happens in your trading. So you have to learn how to be more even keel, as if you were playing poker or any game that you have, because again, the better trader will always win. They'll always grind out the weak. Trend trading is, in this business, price is everything. Nothing else matters, okay? The news is garbage. And if you've ever seen me on TV, you will hear me say that directly to them. They'll say, what do you think about that? I said, it doesn't matter. The markets already have it priced in. Right or wrong, the markets have priced in that information already, okay? The simple is you buy a future when it breaks out and you sell it when it changes. It's that simple, okay? Don't get out before the trend changes direction and stick to the system. Because if you don't, you're gonna be always wondering when the next big win comes, why you weren't in for it, okay? Amateur traders wanna be right. Pro traders wanna make money. Which one are you, okay? Do you wanna see the guy going to the proctologist, or do you wanna be the one making money? It's a very simple question, because either you can follow rules and you wanna make money, or you don't want to follow rules. You might continue to try to, freewheel it on your own. Which, hey, listen, I want happy members anyways. I want people that want to do what we're supposed to do, and not try to reinvent what works unbelievable. Okay? Now, 66% is our win rate. Okay, do you know what your win rate is? Okay, why is it important? Because it helps you with adding to your position when it's time, and not adding with new money from the outside, but adding with money that you've already made, so that you can regrow your portfolio from a base model all the way up to as big as you want it to get. Okay, and again, so that's why your win rate is important, because it allows you to know when the advantages are more in your favor. Because in markets, after certain circumstances, based on equity curves, which you will see shortly, okay, there are great entries that are better than others, especially if you're looking for an opportunity to press up on your portfolio. Now again, probably about as simple. I mean, again, probability is what's going to happen. Okay, and again, a coin flip is a true 50-50, because the law of large numbers. Our model is 66%. And at 66%, ask any sports bettor, if they could hit 66%, how much money they'd make. They tell you billions. I mean, that's exactly what it is, because again, we're playing the highest probability of all. Dear Todd, thank you for making the changes to the 72K. You are so successful, yet still take care of the little guy. You're always out of the game. I admire that. You're an inspiration to me, an example to follow. Thank you. I see these all the time, but I'm not trying to brag. I understand that I want people to be successful. That's why I get these types of emails daily. Now, we've got in this model 4 different portfolios, okay? They are named by how much money you need to deposit, okay? So the 28K, okay, and this is in your own account. It's got nothing to do with me. I don't touch anybody's money. You have it in your own account, and you can trade it yourself, or you can have, we have one trusted letter of direction broker that trades for most of my members, including me. I have 7 futures portfolios myself. 6 they trade for me. 1 I trade myself, and that's kind of like a hybrid. Okay. In the meantime, this portfolio needs about 10,000 in margin. Okay. Now, the name of the portfolio is 28K, and you open the account with 28K. Why? Because we want you to have approximately 3 times margin, so that if you have a drawdown early, you will not get a margin call. You will not be panicked because your money is disappearing. So you put in 3 times the margin, which goes back to relate to that I said that we've never had to to add new money to an existing portfolio. Then there's, of course, the 17K. Okay, and then we have 2 miles of the 5K. Now, the reason we have 2, the original 5K, you know, when margins went crazy a few months ago, when crude oil was below 0, and if you remember, the margin never came all the way back down. So we needed to bring in a new 5K for new members so they would fit the qualifications of only using, you know, having 3 times the amount of margin in their account. Because again, it's very important that you understand the basics. And I'm telling any of you, if you decide to become a member today, please, even if you have a lot of money, start small, okay? I mean, again, I've got people that, you know, that have come in with, you know, $1 million, and I go, listen, do me a favor, just start with the basics and understand it, feel it, see it, touch it, let it work, and then you can continue to grow it, and then you can grow it organically. Now, 28K portfolio, and this is the 28K right here. And this comes out, this report that I send out every Saturday morning. I send it out about 3 a.m. my time. Again, it's only because I'm up at that time, okay? But this tells you our current positions across the board. You can see our entry date, okay? You can see the fills, okay? And these fills are based on the letter of direction trading that the broker does, so they're all consistent, okay? And of course, we give you a running total. Now, a lot of these have been in for longer than the date shown, but if you know anything about the futures or options market, you know that they have rollovers when things are going to expire, so you have to roll them over. So, but in the meantime, either way, it's all good, doesn't matter. And then we have what we call our mega trades, which in this model are 500 or higher. And we just finished with the cycle. We had 9 mega trades before we started the drawdown. Now, we have, these are the actual results. And of course, we've been in a drawdown, so you can see our profit factor is low. Normally, it's between 7 and 10. It's been as high as infinity when it's really hot. But again, 2 to 1 is a great number. We're usually 7 to 10. But this portfolio has had, okay, 58% profit to this point, even with the drawdown we're in right now, all right, and over 150% lifetime, okay? So in the last year, since January, okay, we're up 58%. And since the inception, which is about 14 months ago, we're up 100 and something, okay? Now, this is the equity curve in which I do send you each and every week as well. So you get all this information every week so that you know exactly where, and here is, I send you all the results. Now, obviously, the cut and paste and I'll put that all here would be, you know, kind of silly. So here, if you want to see them, I show you every single result every week, okay? And we just keep a running tab all the way down from inception all the way to where we are now, okay? So what we're looking for now, my members now that have been in for a while are looking to press, okay? Because they have enough money that when they're trading on one contract to make it 2 contracts, and at the same time stay within the rules of margin, okay? Which again is very important to me that you stay within the rules of margins. So you get every result. Again, win or lose, I send you the results. I'm not trying to hide from you. I want you to know what happens each and every week. The 17K, now the difference, just so you understand, the 17K, the difference between the 17 and the 28 are basically 3 products, okay? In the 17, it's a little bit more conservative. We don't trade notes, 10-year notes. We don't trade mini crude oil, and we don't trade mini natural gas in this portfolio. This is basically all equities, currencies, and grains and metals, okay? And again, you can see all the entry dates. You get the same information, okay? It'll tell you the exact fills, the direction in which the market is going, okay, that we are, where our position stands. And again, this comes out every Saturday. In the 7 you can see the profit factor is 7.5, which is more our norm. This portfolio this year is up 152%, and lifetime to date up 243%. Okay, and these are legit real numbers. Okay, And of course, you can see the equity curve. Okay. And of course, this is not pressable yet. We're still looking for a little bit bigger of a drawdown. Okay. But again, we will be pressing this shortly. But as you can see, it's constantly growing. We just came off of new highs on the 25th of September. Now the 5K, okay, the original 5K, the old one, okay, it's done unbelievably well. Okay, it's right now, you can see all the positions. Now these have actually subsequently reversed. The Dow is now long, just full disclosure, as is the Dow, the NASDAQ, and the soybeans are all long now. They changed this week, so they'll be updated and reflected. Now you get the updates when I send them to you, but now only gold is short. Okay, and here's the results here: 172% lifetime. Okay, 45% this year. Okay, so here's the equity curve for here, and again, we would be waiting to press this one as well. Now here is my portfolio. Okay, this is one, and I'm going to tell you the backstory here. You can see my name. Okay, I started this portfolio last November, so let's say it's a year now. Okay, and I only put in 15,000. Why? Well, because I've got 6 other accounts. Number one. Number two, I know about margin. I'm not going to panic or puke out because it gets a little bit hairy. Okay, but you can see the dates that these were generated. So I went from November to February. I was up 50%, 22,594. Okay, then I got to an opportunity where I got to press it. Okay, and then by April, I was at 34,000. So now I was up over 100%. Okay. And then, of course, we got a little bit higher, up to 42 on July 2nd. And now I got the 3 contracts, okay, on July 11th, after a little bit of a drawdown. And now I'm at 45 still. And now, okay, as of last week, I'm at 70,088, all from the original 15,000, okay, with 4 contracts. So I've taken this portfolio from 15 to 70 in less than a year by using the compounding effect. Okay. Now, none of that compounding effect is put into the everyday track record because not everybody wants to compound. But if you do, this is what you can expect over time. Okay. If you follow, again, it comes back to the same thing. If you follow the rules, you can expect to see returns something like this. Now, here's the actual, these are real-time tallies, okay? 28K, it's up 58 year to date, 106 lifetime, 17K, 152, 243, and the 5K, 120, 172, okay? Again, very basic. And just so you understand, all of these models were born, okay, if you want a little bit more backstory, a little bit more history, okay? All these models were born from our what we call the big boy, which is, you can eventually get here, I hope. This is where my goal is to get you here, okay, which is what we call our 226. This is 226,000 open. I've got this one with multiple contracts on. One of my clients my member says this on 20 with 20 contracts across. In the meantime, yeah, same stories, right? Every position, all the prices. Mega trades are 3K or more. Right now, there's 5 open mega trades here. Profit factor right now is a little bit low at 3.2. Okay. The lifetime to date, since 2016, this is up 884%. Okay, without compounding, without anything. And here is the results going back just a little bit over 2 years, a little bit over 3 years right now. Okay, so you can see every print, because again, you see the red numbers. I don't leave those out. I want you to see them. I want you to understand it. Okay, and of course, an equity curve is no different than a stock chart. Okay, they go in the same phases. They have trends. They have uptrends, downtrends, consolidation, and breakouts. Okay, so if you learn how to use that properly, which is one of the things we work on, that's how you learn how to compound your portfolio. So again, here's not to worry. I'm watching the recording. Love your stuff. Keep it up. Your service is one of a kind. I have a margin account at IB. Could I trade in it, or would it be preferable to have a separate account for futures? Well, again, that's up to you. I mean, I prefer you have a separate account just because it's easier to track. Okay, but you're certainly welcome to trade within one. Okay? If I open a separate account trading at 28K, how much do I have to fund it with? It's 20. The name of the portfolio, whether it be the 17, the 28, the 5, or the 226, The name of the portfolio dictates how much you need to put in, okay, to measure up to all my rules. Okay, you're not using that much, but that's how much you need to have 3 times margin. I'm Central Time, not really a morning person, so when your alerts coming out at 3 to 4 a.m., would I be making these trades until 8:39? At the end of the day, it doesn't matter when you make them. Okay, CTG, who does all of our letter of direction trading, it does everything at 7:30 Eastern. Okay, and it doesn't really matter. I mean, again, we're not looking to make 1 or 2 ticks. We're looking to hit a home run in every trade. So when you get in, you know, I got members, China, Japan, Australia, to Hawaii, and all in between. Okay, and so they all get up at different times. Doesn't matter. So if you're using automated, you know what time it's going to be done, and if you wait, it's fine too. If I decide to automate with CTG, what does it cost? It's a little bit more than if you did it yourself, but the convenience is well worth it. And we trade so little. You know, we've only had, for example, this week we've only had 3 trades. Okay, last week we had none. So it just depends. I mean, we don't make a lot of trades because we're looking to stay in the trend as long as we can. If I start on your monthly plan, can I switch to annual? You can always, listen, I'm going to be very flexible with everybody. That's just what I am. I want happy members, as I said. Can you advise them when you think the preferable time to initiate? Look, bottom line, if you sign up today and become a member, you should enter all the portfolios tomorrow or as soon as you get a futures account open. I can't tell you when the best time is because when you try to time it, you end up in the same mess that you always end up with trying to figure out what's next. It's just easier to enter because what do we know for sure? We're going to reverse if we have to because the markets themselves, we're always in every market all year. We're never out. We're never flat. Every day, you get an email, daily update. I send it every morning at 3 a.m. Out goes an email if there's a new trade. Okay. Every week I send you a little report. I write you a little report with all the portfolios. You don't have to pick one. You get your spreadsheet will come with 4 different portfolios. You can take your choice. You don't have to pay more for one or the other. And the other nice thing about what I do for my members is once you become a member, as long as you stay a member, you will never have a price increase. Okay, it'll be that price for the rest of your trading days. So even when I raise prices, which I do, you will still be paying what you paid when you came as a member. We give training, and we've got in your membership, you'll see if you log into my website, there's, I don't know, probably 30 or 40 training videos, but I also do live training, depending on what's going on, 2 to 3 times a month, where I get on a webinar for a couple hours and answer all questions and go through stuff to make sure we're all on the same page and understand it. So again, I'm here to help you and make sure you understand it. And this is one of the best because again, I love engineers anyways, but I want to thank you for sharing what I consider to be the closest thing to the holy grail in investing. I spend countless thousands on investment subscriptions to help me become financially literate. But when it comes to making money on investments, luck kept entering into the equation. Profits came and went. I kept running into a brick wall until I found you. As an engineer, I've always looked for a method of investing that has a mathematical and statistical certainty. Your strategy does. I cannot thank you enough and look forward to following the market view for many years. So again, these are all factual. In the meantime, if you'd like to take advantage and become a member, you get daily text and email updates. Okay. We give you a weekly portfolio update with the profit and loss, either one. Okay. Training sessions, live and recorded. Also, letter of direction trading is available. Okay, for you, and I will take care of that for you if you decide to become a member. And I'm going to take 50 members, say 50 new members. That's all I ever take at a time is 50. Okay. So right today, the special is $129 per month, which is at bubbatrading.com/micro. If you want to go annual, it's bubbatrading.com/micro year. Okay. Again, I only take 50 and I've never not filled all 50 spots. So if you want to become a member, I would love to have you. And I know that we got a couple of minutes. If you have any quick questions, feel free to ask. I'm happy to take them from you.